right? So I want to get your guys' opinion, and maybe when there's more people in the room, I'll ask it again. But you know, I was telling Aaron, I gave myself a scorecard, you know, a personal scorecard. That's something I do like every year. I don't know why, but it's everything from like, you know, from a health perspective to a network perspective to a financial perspective to a knowledge perspective or whichever. But I gave myself a scorecard, and so you know, I'm pretty happy with the year's progress. But next year I do have more ambitions. And so I wanted to kind of start off today's discussion, which we won't quite start yet. We'll give it like 10-15 minutes for the late students. You know, it's like now I know how the college professors feel when the students come in at the 30 and you're like, "What you been, man?"
Don't forget your own days, okay?
My what?
Don't forget your own college. It's left you in college.
Yeah. So yeah, I'm just thinking about, you know, 2020. It's gonna be the new year soon, right? This is the last month, and it's not just the new year to me. It's also the next decade, the start of the next decade. So yeah, I mean the ambitions are growing with the higher infrastructure of knowledge that we've developed in here together, I'd say. Because when you increase your knowledge infrastructure, personally, you're more likely to take different set of actions versus if you didn't have that knowledge infrastructure. So I know a lot more about Silicon Valley, real estate and stocks and equity and all that today. And I realized that this is probably the ultimate play that I should take. So I'm going to start another lecture series like this, but it's going to be hyper-focused around tech, startups. Well, it's going to be a series actually. It's going to be lectures. Well, I put tech lectures. We're going to have pitch nights, and it's going to be also a networking series. So the networking that I'm already doing, I'm probably going to rebrand it or keep it that brand, but start pushing like, hey, it's about hunting unicorns here. Because I've come to the conclusion that, you know, Bernard was just telling me that you could buy a, $1.7 million home and put like 400,000 into it, and then flip it to what, two point whatever million?
Well, over $1,000 a square foot.
Right.
Not even trying.
Right, and so in about a year's time, in that one project, you'll make about $1 million or whatever.
Exactly. So you almost get a 50% return on your investment in a year.
Yeah.
Which,
So
if you just keep doing that, you will be incredibly wealthy. If you're a company owner, if you own a firm doing that,
yeah.
you'll be making like $1 million a year on one house at a time.
Yeah.
It's amazing.
So this game over here is probably even more amazing than you could probably imagine. So this concept's more like create like an entrepreneur ecosystem where, let's say you find a qualified enterprise software entrepreneur and you invest and you say you own like 1 to 10% equity. And this becomes a unicorn, which is $1 billion in value, and you own 1%.
Right.
Right? And we're talking about fast because it could easily, the way I've seen financial markets move in terms of market capitalization, it could easily go from 1 to 5 billion. And if you own 1%, that's a really good amount of money. So this is more of a parabolic, more of a leverage play. And I realized to get fully exposed to this leverage is to own the equity. So those are some of the things I've learned. So I'll give you guys an example. Because we were kind of discussing about it, right? If you work in tech today, I mean any employee that works in tech today, let's say you work in a winning technology company like Okta or Twilio, right? And you get equity, they pay you some equity, but it's always about how much of that equity you own, right? So let's say, you know, if you're at a company that doesn't give you equity, then you just kind of have a fixed model, and that's what you earn over your period of lifetime, until they release you by giving you equity to get exposure to that. So I was thinking that, you know, real estate's really a powerful way to get leverage as well as exposure to inflation. We buy real estate to protect our position, is what I realized. So last week I said, when they print money at the highest level, at the central bank levels, right, it first trickles down to first it somehow splits at the top level among the rich people in terms of like that, you know, treasury contract. And then it'll first trickle down to the producers because they're always like alert and watching the markets. And those producers are typically corporations who could, like I said, afford FP&As or whoever to track the rates. Is that for me? Oh, dude, thank you. You didn't have to. You can put it in here. I don't know if someone might take it out there. Yeah. So going back to the trickle down economics, right? So I realize now that when they print money, it first goes down to the producer, and then the producer, because they're more actively watching the markets, they have more information, they're more intelligent. They'll respond by nature, typically by acquiring more stocks, because they're not going to go and waste their time acquiring real estate, right? It's only when that trickle down economics goes from the producer to the consumer, where the consumer has a natural tendency to go purchase real estate. Because the vast majority of consumers don't play, or households don't play the stock market. So for you people in here who are trying to learn about the stock market, pat on the back, like big time. Check this out. So this is a follow-up chart from last week that I wanted to talk about, right? I said that the majority of participants in the stock market today, if you read it, figure 47, the corporate sector has been the main buyer of equities, which means stocks, since the market low. So look at that household. Since the market low, 08, 09. This is household right here. They've been mostly like selling. Right? And I'm just going to say, it won't be you guys. Let's just say average Joe, average profile. Right? And non-financial corporations. Because there's financial corporations like JP Morgan, but that doesn't count. We're talking about everyone else. So most of the people in the stock market, the players are really, you would think it's institutions, right? Big money managers. They're a portion too.
They're a big setup.
Actually, no, we need to define what institutions are. So I would have to look into this. So I don't think that's correct.
Yeah.
But this I do believe, because every earnings call they talk about share buybacks. So now we know. So now I believe that there's a natural tendency for the producer, when they get easy money, they'll put into stocks. And then when it trickles down finally to the average Joe level, the consumers, I think we all have a social culture and natural tendency to put into real estate. And so when I think about all these moving economics, right? Now that if you think about a average person's lifetime purchase habits, right? Household doesn't really buy stocks. The average person doesn't really buy stocks. And when I used to work at Silicon Valley Bank, after looking at all the broad portfolios, most of them all had their, like 90% of their wealth, the average people had 90% of their wealth in real estate.
It's either 401k or home. I mean, that's more where
That's basically the model. So if you go out there and meet like the average wealthy Silicon Valley person, it's going to be like 90 to 95% real estate. So let's say 1.5 million in equity. $1.5 million home, 700k in equity, and then 200,000 in the bank, or in 200k in 401k, and then 100k in like cash in the bank.
Right.
That's the typical profile when I was analyzing all the accounts at Silicon Valley Bank. So that's how the consumer typically plays. And if you think about it more, it's like the whole model of the consumer is to work really hard to earn a standard of living. And the standard of living, that reflection comes from real estate. So to me, because real estate is the biggest purchase of their lives, residential real estate is the reflection of standard of living at this point to me.
Also the perception of your self-wealth.
Yeah. So when you think about that, it's like, how much is this guy worth? Let's look at his real estate. That's his wealth right there. So those are some of the interesting things I noticed. And I wanted to follow up last week with this chart to share. If you guys have any comments or any opinions on this.
So how come the rest of the world went up and then came down?
The rest of the world,
The small dotted line.
it came up and then it came down in 2015. So we did have volatility in 2015.
Right.
Yeah, we had 2015 looked like the last 2 years.
So is that saying the rest of the world is more astute in buying stocks?
It's more what again?
They buy equities a lot.
Not as much as these guys, but yeah, I guess you could say the rest of the world does participate in some sense, but they slowed down in 2015. In 2015 to 2016, we had another like sideways year for the S&P 500. So that could be the slowdown over here as well with households. Right, households did not participate in this. So now that I think about this, well, anything that's really high is typically a bubble.
Right.
Right. You think about we pull up another chart, right? Let's see. CPI basket. Jeez, let's see if I can find that. Education. Come on. I think I showed it to you guys, but let's see. Education. Oh, I spelled it all wrong. education, home price. Okay. No, that's not the one. It's one of these. Which inflation? Education. I saw another one.
Is that the reason, well, underneath the cost of education just keeps on going up?
It's one of these right here. Okay, so let's go with this one. What was I gonna say about it? So I was just saying that anything that's like really high is a short typically, right? Now, not really like a direct short where you go and short the stock or whatever, but it's in a sense that, now I saw another chart that looks like this. It's not a college textbook, but it's college tuition. So if college tuition is super inflated, then I want to short, but not really short. I want to deploy, develop, and sell. So I want to be Stanford University versus being a student, right? Because I'm getting hyperinflated prices, and I'm distributing at that price, right? And so that's tuition has gone up more than home prices over the years. But it's different because home prices are leveraged, right? So you could distribute, so if home prices are going up, that's why it's really lucrative for these commercial real estate developers to be who they are, because they're developing something that's appreciating in value, right? Now, I know for some reason, because we're looking at what's going up like crazy, right? For some reason, no one's tracking enterprise software. That's gone up like crazy. Right. So you want to deploy that, you want to sell that, you want to develop that. And so that's the inspiration behind hunting unicorns, which I guess we could get started and discuss. You need help with that, Henry? You okay?
I'm good.
All right.
Thank you.
Sorry, man.
Sorry.
Yeah, no, you're good. Let's see. I really want to find that chart though. Anyways, you have to be understanding that things in this economy kind of print, or they inflate. Things inflate. So population inflates because we reproduce. Money inflates because, prices inflate because we print more money. So knowledge, I think, will also inflate as we introduce more technological infrastructure, right? Easy access to information. So again, if you go back to, are we chasing $100 million? I don't think so. We're not chasing money. We're chasing a standard deviation, right? Because if everyone had AI, machine learning technology, it's in everyone's pocket. You have to compete on top of that new infrastructure, right? And you want to be ahead. So that's why I learned meeting a VC an emerging VC this week who had an exit, I'd say. Someone had a comment online. Well, someone's speaking in Chinese. So Hasaki, I can't read Chinese or Japanese. So I do apologize. Just want to make sure. And if you guys online, let me know if you can hear me as well, if you're okay. Okay, anyways. Today's discussion is going to be technical discussion number 143. Super excited. Just for everything in general. It's called Investing Like the Entrepreneurs of Entrepreneurs. I've forgotten S over here. But I saw the Sequoia Capital's original logo last week, and it said, we are the entrepreneurs behind the entrepreneurs. And so today's title is based off of kind of that. Investing like a VC, basically. Investing like an entrepreneur's entrepreneur. So I wanted to start off with this picture. It's just a little piece of art. Hunt of the Unicorn is the name of the picture. Because I wanted to get your guys' opinion. So next year, so this is a sort of more of an investor-facing community. Next year, I plan to build a more tech-focused community. And so I actually want to lecture on like startups and how to build startups. Because I think, I wouldn't say I'm like really good at it, but I think I've met enough startups at this point to advise around market opportunity, what's going on with market valuations, and so forth. So, curious to know what day would you guys want me to host this on? Saturday, 10 a.m. to 12 p.m.? No. I don't know about that one.
Are you talking about at night?
Yeah, I'm thinking about it. I have to make this happen. This is something I really have to make happen because in our last analysis, the two last one, we were talking about how 80% of cloud unicorns are here in Silicon Valley, right? And so because we know those high value corporations are 80% of them are here in Silicon Valley, I also know that high quality human capital is here in Silicon Valley, which is going to cause that high value real estate one day, right? And they're also the future VCs. Because the gentleman I met in SF this week, he has access to like a penthouse. He got a Okta exit, and I think he's also invested in Slack. He made his wealth from these enterprise software companies. So now I was telling Bernard before that I could probably forecast where the next VCs are going to be. So I feel like this initiative is super important. But I'm really focusing on building the community because after a while, to me, it's more about the people you enjoy being around. So I enjoy being around investors as well as the geeky tech people. So that's the hopefully we'll get it started somehow. So I was thinking it would be like a series for the tech lectures, and then we'll have serious pitch nights, as well as it will be with the networking events I already do. So that's the plan for it. But if you guys want to suggest some times.
Monday or Tuesday night.
You think so? Monday or Tuesday night?
I agree.
Yeah.
Not Friday.
For pitching Monday or Tuesday.
Oh, all right. So they're all different, right? So I got to figure out the schedule, but the technology lecture will be probably here for now. But we got some exciting developments. Was it so CEO Ting Bing, startup of a application called Nero? He's in our group chat, right? He knows these wealthy Chinese guys from Hong Kong who I think are venture capitalists. They have like a space on El Camino in Palo Alto, an empty office space that they use like 2 to 3 times a year for LP meetings, right? And so he reached out to me and said, hey, Kay, let's host events here. I'm like, let's do it because it's right across the street from Stanford University. So that could be a spot, but then it needs some work. So we'll see how that goes. But I'm thinking of just, if I were to host, that would probably be the perfect place because we could go walk Stanford University and hand out flyers and say, hey, come out to Hunting Unicorns, right? And then they could tell their parents who are VCs, like, hey, mom, dad, I went to an event called Hunting Unicorns. Because I own the domain, huntingunicorns.com. So that's why, today I feel like, if you want to create something, go for the domain first, and then LLC later. Because the moment you go for LLC and then you go for a domain, it's like, oh, the domain's taken. So I take the domain first, and then I'll think about the LLC stuff later. But that's the community I want to build, because the reason why is that we build up a tech ecosystem. These entrepreneurs will come in, and if we honestly, with whatever you guys learn here, and as a group, help them grow their startup. In return, you can advise for equity, right? And later that VC could invest, and then you get bought out on your equity, or your equity prices get priced up. So this is an extremely lucrative game that I think can only happen here in Silicon Valley. But again, it's not just for the money, it's for the community. Because I think I have a passion for investors, but I also have a passion for entrepreneurs. Because the entrepreneur's problem is like, how do we move forward and build, right? And then the investor's problem is like, I got too much money, where should I put it? so I want to meet both sides on that. Anyways, that's the idea. Any comments or advice or suggestions? You guys think it's a good call?
Sounds fun. It's interesting.
It's only fun if I can make it happen, so we'll see. Anyways, starting with the typical quote stuff. Yeah.
Are you going to have go-to meetings in there too?
Am I going to have what?
Go-to meetings?
Yeah. So, there's some exciting stuff that I want to do next year. Like, I was thinking, like, we could just put it won't be you guys. I don't think you'd be comfortable on camera. I'll put Instagram live right here, and then just be me, like when I'm talking, right? So just kind of start distributing whatever is happening in here. Because I'm getting like a lot of phone calls from startups now, like just like every week. So I get to meet a lot of startups, and I get to see their problems. And I think this is something that I could just share back, right? So last week I had a meeting with ex-ServiceNow engineer who's trying to start a startup, and it's super ironic. Don't say anything, but so the guy who's funding this this ServiceNow engineer, the guy who's funding his project is someone inside ServiceNow. So this is like moonlighting at his finest, right? And this guy's pretty high up at ServiceNow as well. So I get to see like, okay, what you're trying to do and all that. I just feel like it's something that I should start. We'll see. Anyways, did that answer your question? Okay. So starting with a quote, you can't skip chapters. That's not how life works. You have to read every line, meet every character. You won't enjoy all of it. Hell, some chapters will make you cry for weeks. You will read things you don't want to read. You will have moments when you don't want the pages to end, but you have to keep going. Stories keep the world revolving. Live yours, don't miss out. That's like one of my favorites this week, so I wanted to share that. And then another one. So I was looking at the ServiceNow Investor Day presentation, and then I started reading this. I thought it was pretty good. This is actually from ServiceNow. So I'll read it to you guys. So work matters, right? I've been thinking more about the way the way we kind of structure our lives, right? I think work is mandatory. There's no such thing as like, I want to make a lot of money from sitting around. That's just not true. So work is, you have to be honest with yourself. Like, you have to work, right? So pick the work that you have the most fun in. So it's where we spend a third of our lives. It shapes who we are, how we feel, and how we interact with the world. So we must create great work experiences. Experiences that bring out the best in us. When we're at our best, we make everything around us better. Our jobs, our coworkers, and our employers benefit. And our lives benefit even more. Because by making the world of work work better for people, we make the world work better too. So yeah. Ginesh, you okay over there?
Yeah.
Okay, all right. Well, there's seats everywhere if you need. Let's see. So that's the quote, guys.
So how would you make work better?
How would I? So you have to be completely honest, okay? So I always use the example of, like, you want to take drugs. Let's say it'll take you really high, but you got to pay it back later with you getting really low. And so from a mathematical perspective, it might be a neutralized. I don't know if you're neutralized there, but that's an example. Another example I use is if you want a back massage, someone to give you pleasure right here, well, someone has to exert pain, right? So if you ask me, like, how do you work better? Pick something that you're most engaged and passionate about, just industry or group, community, or work that you're having fun in. So that's my take. When people ask me, like, how do you find your passion? I don't know if I found my passion. Maybe, I don't know. I tell them you could do it through the topic where you're most engaged. Figure out the topic. And if you can't do the topic, then figure out the people you like being around. Right? Because for some reason, the topic will fall into an industry in a group of people, and you'll find that people. Or just figuring out the group of people, that people will have a certain habit, like snowboarding or cooking, and then that's your passion, because you like talking about it. You have to be able to talk about it, I think. That's my opinion, but I'm not the expert on that. Yeah. Okay, anyways. No more quotes. So following the follow-up chart, we talked about this already. You want me to go over this again for people who just came in, or should we skip over to the next part? Okay, all right, for those of you who want to know what it was about, feel free to reach out. So to stack this on top, right, we were saying that most of the participants have been corporations. So if you go down, we also have this chart that we already know. It talks about S&P 500 buybacks. So we're at record levels of buybacks. So again, it just reinforces this chart right here. Sorry guys, getting like a little congested in the nose.
Do you use buybacks as an indicator of a company's health overall? Because they're kind of artificially raising their price by buying back stock, right?
Yeah, so, sorry, I'm like congested for some reason. So for buybacks, they don't have a choice. So I was saying earlier, were you here when I was saying when there's trickle-down economics printing at the top level, it first goes to the producer? So it's just their natural tendency on how to spend. So you gotta think about it this way. When a lot of money gets dumped onto you at the consumer level, what do? I think for the most part, naturally, you buy real estate, right? You lever up, you buy real estate. But for a producer, they can't really, let's say you're Apple. Apple, you probably would buy some real estate, but you have so much money that it wouldn't make sense to buy out all the real estate because you wouldn't optimize it, put it into production. Right? So, I'm sorry, what was the question again?
So when they're buying back their own stock,
Yeah.
what does that say about
It's
the
saying,
company versus?
yeah, it's saying that they don't see any opportunity elsewhere because they got a lot of money dumped on them besides their own stock. Now, there's also internal incentives and biases as well, because if you're an executive, like let's say Tim Cook, and you have a meeting, you bought 100K shares on Monday, and you have a meeting on Wednesday with your shareholders saying, there's no more opportunities, I think we should just buy our own shares. So you're incentivized to pump up the shares that you bought on Monday, and then by Friday they execute the share buyback, and the stock goes up, and you're pretty happy. So in a sense, I personally think because of this phenomenon right here, you see that majority of market participants have been corporations, as well as record levels of corporate buybacks. The bubble today, in 2020, if we were to have a bubble, it'd be one, it's the sovereign bubble, right? Unprecedented levels of government printing and all that, as well as corporate buybacks. Those are the two major bubbles that I personally see. Now, the other one as well is that we printed so much that now all the money is flooded into every asset class. So we're kind of hurting ourselves in a way, because if we all inflate prices, we have to work harder, right? And it's never going to be enough. So it's literally a snake eating its tail. I'm sorry, you had a question as well?
So this is a good thing then, right? I mean,
It's good if you have exposure to equity. It's very, very bad if you don't have exposure to equity, because it actually makes you poor. And it makes
that makes everything more expensive.
it makes everything more expensive, as well as, look, okay, this chart tells you right here that the majority of households are not really playing the stock market, but the majority of corporations are playing the stock market. So what happens when you print money? Well, let's say the 1% up here, right, who have majority of the wealth, and then let's say the 99% over here, who don't really have, they have majority of the jobs, I'd say, the sweat equity. But the reality is that over here, if I were to change colors, they have, let's say, 90% of the assets, right? And then over here, I'd say, I would probably say 95%. And then over here, it's like 5% of the assets, right? So the difference is basically what happens when you start printing money, right? Whoever has 95% of the assets, when you print money, assets go up in value. So the distance right here actually expands and get longer, right? Away from this group of people. So it's really gotten to a point where we printed so much money that everyone has to work and has to invest the money.
So
If you don't invest the money, you're not exposed to assets that inflate when they print money. And so you get poorer just through back-end engineering.
So the buybacks, are they coming because the interest rate is so low and it's so
Exactly. So top level determines how cheap money should be, and then first knocks down to producer level, and producers are like, we have nowhere else to put it but our own shares. And plus we have incentives to put it back in our own shares because we're gonna get richer, right? My security line of credit would be nicer than my home equity line of credit. So you guys know home equity line of credit, right? Where you buy a home for $500K, it goes up to $1 million, then your home equity is like $500K. Well, you also have a security equity line of credit, meaning like your stock went up this much, but you don't want to sell it, but you want to leverage off the stock's equity. Banks will lend to that, but that's more of a upper level broker, wealth
That's
type
how
of.
Jeff Bezos gets all his money, right?
Yeah, I mean it's just money. Money makes money, man. Money really makes money. So
I'm so surprised with this though. I mean, if you look at the number of people in America that have no savings at all.
yeah,
And
I don't know how they're gonna get by.
An expensive, well, they say like $400, an unanticipated expense of
Yeah.
$400 would require a loan or a credit card. And that's like a massive percent of the US population. So just think about that for a moment. Go back to that graph.
Yeah.
What that's telling you, the adage of the wealth getting wealthier, right?
Yeah.
It means that when you're wealthier, you can have greater risk. When you're not, you're barely saving
Yeah.
anything.
Yeah.
And that graph there is telling you that you're actually not saving, it's actually negative.
Yeah.
So you're actually spending more than you have, you're getting more debt, and you hear these crazy statistics of people that have freaking amazing amounts of credit card debt at 20%, right? That's why you hear all these
Yeah.
stupid ads,
Yeah.
right? Lower your credit card debt, and so that's why you see tons of them. Because
Yeah.
they know that there's
Now,
astronomical amounts of people out there that have it.
Now we know tuition prices have inflated more than home prices, right? Through some charts. And if I ask you, have you heard the saying, the whole 30s is the new 20s, man? Oh, or has anyone in here heard of that? Bernard hasn't. Anyone else?
30s is the new 20s?
30s is the new 20s, man.
No, I haven't heard that.
Okay. Well, that's 30s is the new 20s. Now remember how I said like if we have like a common language among a social population, right? Where it's like, oh, engineers make a lot of money, and that typically kicks back to like, oh, this software company is it's really bullish, right? So when we say 30s is the new 20s, because of this economic economic phenomenon happening at the upper level, is actually pushing out age groups in terms of experiences, realistically, right? So like, before, maybe in your time, you probably got married, the average marriage would be a lot sooner, like in the 20s, but then now it's like, there are statistics showing that it's being pushed out. So as we keep tightening this up, right, the 30s are gonna be the 20s, but we keep pushing that out. The bigger question is, are we living longer? Because if technology doesn't make us live longer in the back end,
Well, we are living longer. That's why the
we have to,
Social
right?
Security tables
So,
have changed. So
yeah.
that people are living longer, and they may outlive their overall savings too.
Yeah. Now that's an issue for the pension funds, big time.
Absolutely.
Yeah, there's a lot of volatility out there, or
But then I
suppressed volatility.
long enough time also producing wealth. at
Yeah.
the same rate because health
Yeah.
is really not keeping up at that rate.
Yeah,
Right.
yeah. So that I'm a big believer that every empire has its beginning and end. Because we talk about the Roman Empire that lived for 450 years and we're only 250 years, and towards their ending they devalued the silver down to silver wrapped in 99% copper.
Well, so one thing that you do, Kay, and I keep complimenting you about this, by the way.
Okay, sure.
This is the kind of knowledge that they don't really teach you in
They
school,
don't want you to
okay?
notice, man.
So let me just put
yeah.
an example on the table.
Yeah.
Okay? It's basically 2 or 3 weeks away from the end of the year.
Yeah.
So how many people in this room have thought about what do I need to do before the end of the year from a tax perspective? I bet not one person in this room has thought, should I max out my 401k or my IRA or whatever? Nobody, right? Because they don't teach it. They don't tell people
they
that
don't teach
on
it,
December 31, when the clock hits midnight, you missed out on the 2019 opportunity to change anything
Yeah.
in your best interest for that year.
Well,
they don't teach
they,
it
they
at
don't.
all.
No one wants you. No one wants you to know that. Everyone wants you to know the corporate structure, which is like CEO or shareholders at the top, right? But nobody wants you to know that the value is like this.
No, what
All
I'm
the
saying
value
is
goes to
that
the top.
In the schooling systems, they don't really teach you what is an IRA, what is a savings
Yeah.
account, why are you having a credit card when you have a home that you own that you should have a home equity loan at 2% instead of paying 20% on your
Yeah.
credit card.
Yeah.
I had a woman working for me, an engineer, freaking bright as you can imagine, right?
Yeah.
Probably about 30, I guess.
Yeah.
And she had $30,000 in credit card debt.
Yeah.
And I said, well, that's kind of strange. I mean, sort of asked, but don't you own a house? So I said, well, of course I do. Well, why don't you have a loan of credit? What's that? It's like, holy shit, man! You have $30,000 of credit card debt, but you don't even know what a line of credit
Yeah.
is on your
Yeah,
house,
yeah.
where you'd be paying 2%
Yeah.
instead of 20.
You
Think about the numbers
well-
of that. That's like spending $6,000 a year. Instead, you'd be paying, $1,000.
So
I mean, they don't teach it though.
look, nobody. They don't want you to know, but then people don't want to know themselves, right? Like, if you say you're an entrepreneur in your family, probably like 19 out of 20 times, they're gonna say, you're gonna hear, you're crazy. Don't do it. Go get a stable job. But then that's like the majority, and so the majority keeps breeding the majority over and over, right? While the producers, they go build up their business momentum and start sending out credit card ads and all that and live this lifestyle. Just watch Netflix all day. Spend your time watching Netflix. Consume Netflix while we produce Netflix and get richer.
Absolutely right.
No one's really taught that you have to have a balance of living and playing. Working and playing.
Right.
Right. It's a story. Oh man, someone gave me this story this weekend. I thought it was just brilliant. It's the grasshopper and the ant story. Have you guys heard that story? Let's see. I don't know if he's online, but he'd be pretty proud of me pulling this up. The ants and the grasshopper. Okay, I'll read the story to you guys. One bright day, and it's super funny. If like a realtor comes by and he sees like we're reading like kids stories, like that's a lot of people attending a kid's story. One bright day in the late autumn, a family of ants were bustling about in the warm sunshine, drying out the grain they had stored up during the summer, when a starving grasshopper, his fiddle under his arm, came up and humbly begged for a bite to eat. "What?" cried the ants in surprise. "Haven't you stored anything away for the winter? What in the world were you doing all last summer?" "I didn't have time to store up any food," whined the grasshopper. "I was so busy making music that before I knew the summer was gone." The ants shrugged their shoulders in disgust. "Making music, were you?" they cried. "Very well now. Very well. Now dance." And they turned their backs on the grasshopper and went on with their work. So at the bottom it says, the lesson is there's a time for work and a time for play. But what I've learned is that 90 to 99% of everyone's a grasshopper. Yeah. Now there's also through this whole concept of 9 to 5 and work and all that. The value split is not fair. Like I said, this is the corporate structure, right? You guys all know the corporate structure, but the value creation is always like this. So it's only a matter of if you want that value creation and make it fair, you have to get equity. But then you don't know what percentage equity. They could give you equity, but it's 0.0001% of the 100%. So yeah. It's I'm not trying to make it depressing, okay guys? This is if you notice stuff, then you'd be a lot brighter tomorrow, and it's a brighter day. Shoot, I know we kind of digress a bit, but did I answer your question, or
Absolutely,
did any other
absolutely.
questions you have?
Well, that just actually reinforces that the situation is getting worse.
It's
Okay, if you look at it from a 5-year perspective, it basically means that
it's unsustainable.
that's right.
It's-
And you know, we're now living in a time where the economy is relatively strong,
Yeah.
but it overall shows the vulnerability of what can happen in a downturn.
Yeah.
Look at Canada, for example. In the last quarter,
I mean, why do you think I'm the gold mining guy right now?
right, but just look at it this way.
Yeah.
The United States has one of its best quarters ever in terms of employment, but Canada has its worst
Yeah.
in 50 years.
Yeah. Yeah.
So what does that mean?
Like-
It means that Canadians actually are in worse shape than Americans are. They have twice the amount of debt
Yeah.
and twice the risk of having a catastrophic failure in their economy
So-
than any other economy.
So, like I said, if you do a global macro analysis, the two biggest, the two Achilles heels of a person, both of them, not just one, okay, is sovereign debt bubble or sovereign debt crisis and corporate buyback crisis that's pending.
Right.
Those are two majors, right? Buybacks, as in they had nowhere else to put the money, so they did it in buybacks, and that's why stocks are up. But when stocks go up, these executives get paid out on stock options or stock bonuses and so forth. Then they go purchase real estate locally, pump up the prices, and then the consumers at the bottom have to compete harder, right? So that's sort of the corporate bubble, because we're at record levels of share buybacks that we haven't seen since 2008. But that's because of engineering at the sovereign level. So it's not really consumer right now, I'd say. There's not much of a consumer issue besides like student debt. But it's really, so consumer's okay, right? But it's really the sovereign and the producers that are concerned. If you go from sovereign, producer, or regulate, if I use other words, regulator, workers, and ants and grasshoppers. I don't know if that made sense. But yeah, that's the situation we're in today. And if you want me to review the doomsday scenario, right? Like, how could we fix all this? There's only 3 ways. This is how I remember it. So 1 is we fix it, 2 is we continue, and 3 is doomsday, right? So if we fix it, that means you're paying like 50-60% tax, net tax today, right? You net out sales tax, capital gains tax, whichever tax, property tax. You're paying probably 50-60%. Can you pay 80 today? That's how we're going to fix it. I mean, you laugh because you're not going to do it, right? And so that game is going to continue. And this is where I realized, like, oh my God, I have to learn to be a tax specialist. Because I know the financial profile of the governments, it's so bad, and I could already guarantee you that taxes are going up. So the people in the population, as we play this game, if you don't know how to hedge with tax hedge, you're going to be in trouble. And when I talked to the commercial real estate developer, right, he said, "Kay, like most people don't realize this. We don't make money from simply buying a commercial real estate, piece of building and then restructure it and flip it for the value. They don't realize that 30-35% of the value is coming from tax strategies." Right? So now I'm starting to see like the engineering loopholes that are out there. We have to learn about tax, planning and all that. That's just mandatory at this point. Because if you think about the population, right? It's the ones who set the rules, they already know about the tax, and then the people who study about taxes, they're a CPA, right? Right? People who study about the taxes know about that, and then the rest of the world who doesn't know anything about taxes. So as we move forward, taxes go up, the rest of the world pays a high tax, the people who know the tax laws start saving, and the people who made the regulation, of course they're going to know where the loopholes are, because they made the regulations. So-
Why can't it continue where they keep taxes low like they're doing now, but then the central banks just keep adding liquidity? I mean,
So they can't continue, right? So this is the other side. So there's a tax specialist. You come in here and you meet me. I'm more of an investor specialist. What's happening is that if they're at the max in terms of raising taxes, right? 60 to 80%, that'd be crazy. So their last tool is really to engineer the back end. We can't ask up front, the front end, to ask for more taxes. So we'll engineer the back end by devaluing the dollar and inflating prices all around, and we'll take positions in assets. Right? We'll buy gold, we'll buy real estate, we'll print money, those prices will go up. People who don't invest get robbed. That's a hidden form of tax that Ray Dalio talks about all the time. So that's the answer, I'd say. If perceived taxes are too high, interest rates are low, make money even easier. So it forces one to invest. So now I realize that if you don't learn how to invest, you don't learn how to tax hedge, and maybe if you don't even learn about politics, these are all like super core to like living here. in this new world if we decide to continue. So going back to the situation, right? If we decide to fix it, then I think we'll pay more taxes. But I don't think anyone's going to do that. And I honestly think it's going to be number 2, which is we continue this pain. But I'm going to skip over to 3 because it makes sense in this direction. So doomsday scenario, if you ask me, I've divided it into pre-doomsday scenario. Pre-doomsday scenario would be the collapse of the currency, meaning they devalue the hell out of the dollar, right? And so the dollar is basically worthless, and then we get hyperinflation in asset prices. Real estate skyrockets, stock skyrockets, because the dollar is worth nothing, right? It's just a simple math, equation. So I would say that's pre, right? And then I think people will start questioning the store of value of cash, right? And I think we'll default to real estate as a store of value. Meaning, like, because there's more than one person in society, we have to keep that store of value somewhere. You did a favor for me, I did a favor for you. We might have that in a, mental ledger, but society doesn't know that. So that's why we have this whole concept of store of value. So I think the real doomsday is when the legal system collapses. Because at that point, real estate, it doesn't matter if it's your real estate or not. That ownership doesn't matter. So that's when the store of value collapses. And that would be real doomsday. But I don't think that's the case. I think it's number 2, where we'll just keep devaluing the dollar. And then I think consumers will adopt. But producers will always adopt first. Regulators will always adopt because they set the rules. And then producers will adopt because they pay attention to the rules. And then consumers will adopt last. That's sort of the pattern I'm seeing in my head. Yeah. So I'm getting like pretty congested today. I think it's the weather or something. So I apologize for the voice.
Might be a virus. Just a joke.
Okay, all right. Let's see. So any questions? Oh, clear. Any questions before we get started on today's discussion on?
No question, but just a comment. Very timely article in Wall Street today. Investors bail on stock market rally, fleeing funds at record pace. So anyone wants to go more details, I can maybe download a PDF and I can share.
Sure.
Yeah. So which says that it's even the institutional investors, the outflow from the ETFs and the mutual funds has been the record base in 2019.
Right. Interesting.
Even though the stock market has risen 25%, so which is what we've been talking about.
Yeah.
So it's today's article.
Yeah. I mean, there's a lot.
Bonds, and what they say is money going into a lot of bonds and treasury. Basically, flight to safety.
Yeah.
Metals.
So I'm not seeing that in the markets. Before we get started on the investing like an entrepreneur, like the entrepreneurs of the entrepreneurs today, I'm going to do a quick market overview just to kind of share what's going on. It'll be very quick. So because today's more of a discussion on technology stocks and where that market direction is going, because I perceive that one as probably the most bullish, as well as it'll kick back into Silicon Valley real estate. So let's take a look. So majority of the markets, if you ask me, I mean, we look at the indices over and over, right? USA indices over and over. Just a general market direction of the world, this is what I'm seeing. Everything's kind of pointing up, so things are calm. When things are pointing up like this, most of the time I'm just kind of biased on the long side or on the calls. And plus they're printing money too, as of October 11. So as of October 11 right there, you kind of see the bottom. They announced that they're going to print extreme amount of money. So you see what happened right here, right? October 11. October. And how can I prove that to you guys? You go to the Fed balance sheet. And this is from the governments themselves. Total assets, and then we'll zoom in to around October is when they announced that they're going to, well, the markets might have moved first, but around October was when they announced. So right here, September, October, right? This one was like emergency repo stuff, and they just kept on printing all the way. So they started printing money again. They were tightening, as you can see, but then now they're giving it all back. They're printing more money. So that's typically tailwind for the markets at this point. If you look over the bond markets, you asked me that people are shifting out of equities and into bonds. I guess you could say that bond prices have been going up, but for a little bit now, it's been kind of in decline. So typically when bond prices go up, interest rates go down. So when they're notifying that, hey, we're going to lower interest rates, well, bond prices are going up, and this is bond prices. But it's kind of retracing at this point. So it's slowing down. If prices were, If there was more fear, I think bonds would go up, causing interest rates to go down. But we're not seeing it currently. We're seeing bonds selling off and equity markets going up. This could be due to more printing of the money, right? More printing of the money means lower interest rates. Lower interest rates is less attractive. Lower interest rates means higher bond prices. So I guess that's the dynamic we're seeing. Looking at metals are kind of taking a break. I don't have much to say about this besides the comment that we had last week, where I think it was going to go sideways to slightly down. But I'm still, from a fundamental perspective, I'm still very bullish on metals. I know it doesn't look pretty. It's taking a break. If you zoom out to the weekly, it's at a 6-year high, so it does look attractive. We do have a bull flag right there, if you want to see. So this is the weekly chart. And then if you zoom out to the monthly, this is what it looks like. So gold is, again, at a 6-year high. And there we are. You got that rounded bottom, that breakout at 1400. So I think it's just getting started, right? The guys who are really serious about gold, some of the projections I'm hearing is like 3,000 to 5,000, and then some of the crazy ones are saying it's really 12,000, man. Yeah. But if you're kind of scared of your gold positions, from an investor perspective, long term, it's actually really bullish because again, we're printing money, and you've heard about the two major crises that are kind of pending in the background, the super suppressed volatility that we're having. How do you know if this is like a really firm move? If you look at the volume right here, and you look at the move right here, this breakout was on high volume, right? Typically something like that, and again, this is on the monthly, so it moves a lot slower. Typically on something like that, sets up for higher moves. It's just a matter of being patient. I think this pullback, this correction in gold is definitely something, this is not a recommendation, all educational opinion only. It's definitely something that I would consider a buy.
Could you look at the palladium one again?
Sure. So palladium's been, now this could be more of a specific market supply issue, but this one's going to all-time highs. So typically when something goes all-time highs, it just keeps going up. But
so palladium's used in a lot of electronics and so on, right?
Yeah.
So is there any way to correlate, is this demand overinflated versus the companies that are making products that use this? Do you know what I mean? So let's say someone makes twice as many cell phones or whatever this thing's used for.
I would probably use semiconductors.
Sorry, but could it be because it's one of those rare earth metals which is used in semiconductor industry and mostly China is producing? So ever since we started having this trade war, there is a lot of concern and holding around the palladium because we don't know, between China and US, the trade war, what if China stops the supply of palladium? I don't know that, because there have been a rally in those what called rare earth metals.
Yeah.
Because China has the biggest supply of it, and ever since US and China started the trade war, people are, skeptical about buying it.
Yeah. Yeah, so if you guys ask me, I'm not tracking palladium, I'm really just tracking, I do a little bit track copper for more economic purposes, but I'm really tracking gold, silver, and platinum. So gold's at a 6-year high, silver is really low still. It is at a high, but I wouldn't say it's at a 6-year high, like gold. And then platinum's also really low. Now, if you're from a more investor perspective, I think now more than ever, the timing-wise looks pretty interesting. But the current condition, short to medium term, is probably down. So, but down's good for people who haven't taken a position. So that's what I'm seeing in the precious metal space.
How do you invest in palladium? Are there funds or similar palladium miners?
Sure. So there's an ETF out there. I'll pull my Finviz. So the stock market is pretty godly today because it has engineered almost every product. Like you could get Forex exposure in the stock market. You could get specific industry exposure. So one way to buy palladium besides futures is, I think it's Paul, P-A-L-L. So this would be a palladium ETF that tracks the actual prices of palladium.
So is that equal to GLD?
Yeah.
Same idea?
Yeah.
So are also palladium miners with the same kind of leverage too?
Yes, but I don't specialize in palladium miners. I'm more of a gold and silver miner right now. Yeah.
Okay, so those gold miners that you follow, there's no comparable set of them compared to the palladium miners.
There should be, but I don't know the segment.
Okay.
I haven't done analysis on it. I'm more of a, again, gold and silver specialist, just because I see, this price action right here is bullish. I think it will continue to go up, but gold and silver is kind of setting up to be really parabolic in my opinion. Again, just because of the global macro uncertainty, the 120-year sovereign debt cycle, as well as 5,000 years of lowest interest rate ever, right? Remember how I brought up the 5,000-year interest rate chart and we saw the cavemans charging each other like 20%? And then Barath was in here and he laughed out loud. Like they were charging like 20-25% on each other. Today we're charging like nothing, right? Well, I mean 3% on real estate, but essentially nothing. Anyways, so that's the quick global markets from index perspective. It seems pretty calm. I mean, we did have a dip in a week, but nothing much. Bonds, I don't see people running to. Metals is kind of going sideways, or sideways to slightly down, which is anticipated. If you want to look at cryptocurrencies, I think it's still holding that price area. If you look at it right here, nothing much on cryptocurrencies. I am bullish. Okay. Now, it's not a recommendation, it's all for educational opinion only, but 8,000 is my mark. If it's above 8,000, I get bullish, but it's still below 8,000. I'm bullish, again, if I were to reiterate the thesis, it's because it's technologically bullish, demographically bullish, right? If you think about the 20s is the new 30s, these millennials and so forth, they have to have their wealth building cycle, right? Late generation X, let's say, people who are like, I forget the age range, like 40 to 55, 52. Generation X, they had their wealth building time frame in terms of real estate. So they bought real estate and appreciate aggressively, right? And then now some of them are moving on to, let's say, baby boomer gray area, they're distributing. So how do the next, you have to think of it as like a conveyor belt. How does the next demographic group, the millennials, position in, right? After the X, and then millennials, and then Generation Z. So if you forget the generations, it's the silent generation, the baby boomers, and then Generation X, Y, and Z. So I'm Generation Y, which is millennials. And then Z is, I think, 22 and below at the moment. So I have to think about their future, how they position into this world, right? Because I think if you become very mature with economics, like how I say, if you respect the laws of physics, you wouldn't go and jump out of that window and hurt yourself because you understand the laws of physics. Personally, for me, I understand the laws of economics. So whatever I do, if I want to gain, I have to work. So be very mature about that. So yeah, I do. So again, it's technologically bullish, demographically bullish, mathematically bullish because it's a fixed asset and they're printing more money. Then typically something that's fixed like this will have some upside. What else? Global macro bullish because sovereign debt crisis, we haven't seen that for 120 years, as well as so many other things. So that's my quick take on Bitcoin, guys. And that's all I have for the quick global review. Let's jump into today's discussion because we only have an hour left. So investing like the entrepreneurs of entrepreneurs. Where did the inspiration behind this discussion today? I mean, I get a lot of inspiration every week, but this one came from Battery Ventures report. So the last time we had a Battery Ventures report, I think it was back in like November last year, or actually, it was sometime this year. I forgot when, but they released another one, and I just found it to be really interesting. I want to share it this week because to reiterate, why is this so important today? Why do I think this is a topic worth discussing? Because you guys are bringing your time and physical presence to me today. I got to give back somehow. One is we know that the cloud index is probably one of the most bullish index in the marketplace today. Meaning I'm super bullish on software, and I want to figure out how to play it. Not just in terms of financial positioning, but you could also socially position yourself by building a network, by intellectually positioning yourself by building up the knowledge in that space, by not just knowledge, but experientially positioning yourself. So there are several ways to play this because, again, 80% of the unicorns exist here in Silicon Valley. And again, there's one more way to position is also real estate. Because now that I think about real estate valuations, they really, really, really come from the enterprises that are really appreciating. And so in last week's discussion, we were talking about this company that was in Sequoia Capital's portfolio. It was called Medallia, MDLA. So this one I haven't done research yet, but I'm actually very interested in doing more research. They're valued at $3 billion, and it's about 10 price of sales. So that's about 50% to me below market value in this current marketplace. So it looks attractive. But I did a deeper analysis in a sense. I wanted to see where Medallia's headquarters was located. Right, and they're located right at San Mateo. If I go to maps, I wasn't anticipating a full class today, so I didn't turn on the AC. I do apologize, guys. Let's see. So this is where Medallia is. So in last week's discussion, right? I'm going to bring up Bernard again. I talked to him over chat, saying like, dude, I'm very sure I could predict where the next VCs are going to come up in Silicon Valley. And one way is to kind of analyze where the hottest enterprise software companies are. Because if you understand trickle-down economics, right, how I said, if it trickles down from the top, it goes to the producers, right? Now, if you analyze the producers, who are the best producers in the marketplace? Well, you could look at, Apple, Facebook, Amazon, all that. But what if I want to localize that and look at the best producers in Silicon Valley? So I know Silicon Valley is pretty much a powerhouse in terms of like building out the cloud infrastructure of tomorrow. So when I look at Medallia, this is a Sequoia Capital funded company. Sequoia Capital is the #1 venture capital firm in the world. So again, trickle down economics from the top, regulator level down to producer, localize it down to Sequoia Capital. So Sequoia Capital has deployed their funds to this company. What does that company do? They will go and hire employees to get this company rolling because this is a huge market opportunity that those employees are tackling. So I'm bullish on this stock, educational opinion only. But at the same time, if this stock goes up, the employees will also appreciate in net worth value, right? And they could potentially become future VCs. And I've learned that this week because I had a meeting with a gentleman in SF. He treated me out for dinner on a Friday night. It was pretty cool. We talked about enterprise software, but he got an Okta exit. So he probably made, I don't know how many millions from Okta, but now he's an investor in Slack and so forth. So now I'm thinking about, okay, how did he build his wealth? And how did that affect the local geography and all that? So now looking at Medallia, right? And if you zoom into Medallia, it's off of this highway right here. And is it this highway? Yeah, once you go into this highway, and exit this highway, you're gonna see a lot of commercial real estate development around there, right? So I anticipate that area to start appreciating from a more aggressive local perspective than like other pockets. So that's one way how I kind of evaluate real estate prices, looking at what corporations are around it. So something like Santa Clara, let's say, we're gonna look at ServiceNow today. ServiceNow is a IT enterprise software titan that I think has a lot of upside. I don't know what that would do to real estate prices, but it's exciting because there's a lot of people I want to meet at ServiceNow. Anyways, that's the analysis, okay? So that's why we want to understand this market opportunity a lot more. So starting with this, we're long cloud infrastructure and open source software. You guys know what that means, or need a quick explanation?
Maybe a quick explanation.
Okay. So, are you a software person?
No, I can talk about most of it.
Okay, all right. So Silicon Valley, my understanding at this point, so we can turn on the AC. So Silicon Valley, I meet about 400 people a month through like networking events and all that, right? And then also teaching. And I realized like it's divided between hardware and software, right?
It really is. It's a pretty strong division.
Yeah. And the vast majority is really software, just because the markets have transitioned that way. Investors have transitioned that way because the margins are thicker. Software is just a leaner business that makes more money with less people compared to a heavy hardware business. But maybe from a more infrastructure perspective, hardware would be safer. But that's questionable now because now I would say everyone has a mobile device and we are our own servers at this point. We could hold up that software infrastructure. I don't think software is going to go away. So the difference here, what we're looking at is we're not looking at hardware. So some of the partners that I have, they were in the hardware decade, let's say. They built their community off of the hardware network. So now me moving forward, I'm leveraging that and then building the software moving forward because this is where it's really...
It's questionable how much newer hardware we really need either.
Yeah.
This is a pretty good form factor for the internet.
Now you're thinking about consumer hardware, right? You also have to think about producer hardware or enterprise hardware. So I've noticed the relationship in terms of hardware and software to be something like this. Of course, the direction is up, but there's a relationship between hardware and software. And I know some of you guys seen this already, but let's say this is the software, and then the other one would be hardware, where it would look something like this, right? So when the hardware is too high, then we have infrastructure to build new software. And then when the software is too high, we need to build new hardware to service the software. That's the relationship. So, but for some reason, due to global macroeconomic tightening of money printing and all that, and pumping up of stocks, it's making us organic humans forcing us to adapt to the living conditions of this area, right? So this area is continually pushing software, which is extremely bullish, but it's going to kick back to our standard of living. And at the same time, they're going to devalue our money, right? So there's a lot of forces out there making us poorer and poorer if we don't pay attention. Again, those forces are if you don't pay attention to politics, which I don't really pay attention much to. You don't pay attention to taxes. and to even real estate prices, in my opinion. Because real estate prices, again, like we said earlier, is the perfect representation or reflection of standard living. And I think the average consumer's effort is to really achieve standard living. Like, I'm not gonna, that sounds really arrogant though, right? I'm not gonna say that, but okay, it sounds arrogant, but this is my interpretation of what the data says, okay? I'm not expressing any opinion, but from the data, it's kind of telling me from an objective perspective that the objective mission, vision, goal of the average person is to buy a home. In other words, the average person's goal is to achieve standard living, right? And because of the nature of our purchase over a lifetime, it typically falls into real estate, 90% into real estate. I'm just assuming real estate is the perfect representation of standard living. So when they print money at the top level, it's what happens to that standard living. It gets more expensive, right? Or when someone acquires more than one property and makes the space more tight, then this person owns 2 standard living. That's kind of crazy when you think about that. So yeah, it's interesting stuff. And as a you know, what I've noticed about meeting people too is that, again, like I said, we're not chasing money, we're chasing a standard deviation, but we're also you know, greatly attracted to asymmetry. You know what I mean by asymmetry? So asymmetry of, let's say, fitness. Like we get, you know, insanely attracted to people who are really fit and like have that health, or people who have a lot of money, right? That's a symmetry of someone who doesn't have a lot, or someone who has I don't know, a lot of knowledge, right? A thought leader and so forth. So
equally repelled by people on the other side of the asymmetry, right?
yeah, like it's
not wealthy,
yeah.
not physically fit. I mean, it's other side.
Yeah, but then if you think about what's going on from a business perspective and influence perspective, right? The businesses that get bigger and bigger, and you analyze the top biggest companies in the world, I tell you guys this, have you noticed that the majority of your lifestyle really reflects the top biggest companies in the world? So we'll pull it up real quick, right here. So does everyone have a mobile device from Apple, let's say? In our world, in USA, does everyone use like, you know, Office or Microsoft Windows 10? Does everyone use a search engine called Google? To shopping on Amazon? To you know, digitally socializing on Facebook? To using a Visa credit card with a bank at JP Morgan? To you know, shopping at Walmart and watching Netflix? So I like to analyze these things because I think about how the world will be shaped tomorrow. And when I localize it, let's say certain pockets like enterprise software, and I realize the majority is here in Silicon Valley, well, dude, this is the game that you want to be in, because if you, like I said, you could own like 1% of a unicorn, right? And that unicorn goes from 1 unicorn to a 10x unicorn, 10 billion. That's not a lot in the financial markets because of money printing. I think it's an adventure worth chasing.
Tell me how.
Tell you how. Well, huntingunicorns.com. Not an advertisement, but that's the plan for next year, okay? But guys, as much as I seem money hungry, I've learned the dynamics of money to, you know, a very fine level that, to me, it's not the chase for money, okay? It's probably a chase for standard deviation, but I also believe now that, you know, seeing the random acts of kindness from people, you know, my man brought some donuts today. I think you wanted to, yeah, if anyone wants donuts in the back. Like what you guys taught me from building a community like this is just a feeling that money can never buy, you know? So I thought long and hard about what am I going to do for the next 30 years? Not 10 years, not 5 years, not 2 years. Because if you the quicker you decide something, the more you'll optimize your path, right? If you look at guys like Jeff Bezos or Mark Benioff, they are customer obsessed or employee obsessed, but they take a position and they stick through it, right? Versus some of these startups that I see, it will go through like 3 years, right? It's the same startup, but the soul is different because all the people turned over to somewhere else. So if I could advise you on anything, figure out where you would stay, not for 2 years, not for 5 years, for 30 plus years, right? If you can figure out that soon, then that'd be really helpful. So thinking about what this community has helped me in, and the level of engagement and the people I get to meet about investing, I really enjoy it. But I also enjoy the other side, which is the entrepreneur side. And that ties into tech and investing and entrepreneurship. So it's going to fall into venture capital. So I feel in the next 30 years, if I'm going to be here in Silicon Valley, I want to continue to teach. Maybe not like 4 times a week, okay, guys? That's going to taper off someday. But I want to start that tech community because I really enjoy talking to the technology people. And that goes back to how do you work better? How do you find your passion? Figure out the people that you want to be around, that you love engaging with, and things that you want to talk about all day long. So those are quick geeky techniques that I learned. So starting this, okay? So why we're long cloud infrastructure and open source software, huh?
Back to the curve, you showed the hardware versus software.
Mm-hmm.
Where do you think we're now?
I think we're, I don't know the hardware well enough. I think Lale would you be confident in answering that one, or you don't know yourself? So if you ask me from, I think software is ahead, and we need to develop out AI and machine learning, so hardware could deploy their inventory. Yeah. Hey Ed, could you do me a favor?
Yes.
You could. So around this corner, there's like a little clock, or just the timer. Just turn the timer. It's the AC. Because I didn't think there's this many people coming today.
I can add into that.
Sure.
I'm on the hardware side.
Yeah.
So basically, software is peak now, but then software is matured at such a level that they need a new computing platform which for AI, machine learning, deep learning.
Yeah.
For that, the hardware need to be changed, like revolutionary. How
Yeah.
do you do that? So now, just like Pentium processor, everybody knows, right? That's called the general processor.
Yeah.
Now there are domain-specific processor need to be that. For you have the chips for specific tasks to do because
Yeah.
there is a demand.
Exactly.
So now you will see many hardware startup also.
Yeah.
If you go like in Bay Area, every other intersection there is a startup which working on the semiconductor or
Yeah.
chip related thing.
Yeah.
5 years back, there hardly any startup.
Yeah.
So that's what we are.
Wow. So I don't know, but that's pretty good insight. And this is from Intel, man, right? So that's another thing about Silicon Valley that I've noticed, that the people that come in here, it's like S&P 500, Fortune 500 grade human capital, that when we bounce knowledge together like this, it's really insightful. I don't think you'll get it anywhere else. So let's get this started because we got about an hour. You guys are welcome to, if you get tired or whichever, there's the bathroom, water in the back, and some donuts, I guess. Thank you, my man, for bringing the donuts. He's like getting ready for the bathroom or whichever. Okay, so we're long cloud infrastructure and open source software. I'm getting extremely bullish on this segment, and it's just so bullish that I don't know. You can leave that open, if you could, the door in the back. Oh, okay. If you could leave it open, so yeah, just let people come in and out. It's gonna get a little hot. Yeah, if you ask me, I'm so bullish at this point on enterprise software that I don't know if, I think it could probably fight a recession. I think it'll go sideways in a recession. Right? In a way, that's like a perfect hedge. Because there's just so much upside to this marketplace. So let's read out Battery's Ventures, what do they see? Number one, cloud infrastructure is growing quickly and contributing to significant value creation. Right? We're talking about value creation everywhere, in human capital, knowledge, to experience, to value creation in real estate around Medallia or around Twilio or around whichever corporation. If you ask me about the Silicon Valley Real Estate Index, it's probably the Cloud Bessemer Venture Cloud Index. So highly sensitive to that, I feel. Now, we could probably get creative and do a Silicon Valley Hardware Index and a Silicon Valley Software Index, and that'd be a perfect representation of probably real estate prices. Leading, right? Very leading compared to a lagged real estate index. Number two, yet cloud adoption is still nascent, and we are in the early innings. Okay, early innings. This is where super asymmetry of risk reward. Where there's I think they said 91% amount of disruption still left. This is substantial opportunity. So I have to build out this community because I see where the waves are going. I'm trying to go with the waves. In this case, it's with the unicorns. Number three. Cloud adoption has enabled a new class of cloud native and open source companies. Again, software companies are evolving as well. Software is evolving. Number four, software developers are innovating rapidly with cloud and open source building blocks. The tool sets are innovating. Number five, cloud is increasing the attack surface and uncovering new cyber opportunities. Why do you think VMware acquired Carbon Black? As well as Pivotal, right? Man, speaking of Carbon Black. It's like a pain and it's like a good and bad. Like yes, they acquired it, but no, I didn't position enough. So battery ventures, right? So looking at some of the numbers, public cloud vendors are massive and they're growing quickly. So I'll zoom in because I know it's kind of hard to see. If you look at last year's growth, so prior year, last 12 months revenue was the darker blue. The lighter blue is the growth that we're seeing. So there's still quite a bit of growth in this space. Now you have to. Doesn't mean you can say, hey, there's not going to be a recession. You still got to pay attention, in my opinion. You always got to pay attention.
Is this US only?
This would, I would say this is USA indices only, public cloud. So actually, no, if it's public cloud, Alibaba could be part of this as
Yeah,
well.
because US there are only 3.
Yeah,
So,
yeah.
So if you're talking about others, then.
No. When you say there's only 3, you're talking like Google, Azure, and AWS.
And AWS.
But we're also talking about, let's say, like a Twilio or MongoDB. That's considered, I think, by their definition, cloud as well. Actually, no, I think you're right.
No, it says public
No,
cloud.
80 billion. Implied valuation.
actually, there's
No, actually, I think you're right.
Because it says public cloud vendors. not
Yeah,
public
yeah,
cloud.
you're right.
Solution on public cloud.
Yeah, you're right. So yeah, specifically these, because the next slide kind of, I was reminded of that. So you're right. The cloud vendors are growing. The titans are growing. Public cloud vendors added approximately 20 billion in the last 12 months revenue, and are expected to continue growing at 50% year over year. Right, and they're gonna have to consume more producer services like software to figure out the solutions. They're too big of an entity to adjust. When I was at Morgan Stanley, the thing that was stopping growth, in my opinion, was regulation. There's so much layers of regulation because it's financial and their scale, right? So apply that same thinking at some, not a legacy company, but a cutting edge company like Microsoft. They might be too big to tackle all little software opportunities that they see. But yet a lot of the human capital is here, which we could discuss among ourselves on weekends to go create a unicorn, right? And we could all be early founders or something. Cloud providers are contributing to significant value. So I thought this was interesting that they did a valuation of like how big is this cloud opportunity. So if you look at these 3 enterprises, I know we don't normally see the full returns of a cloud company because they're not just a cloud vendor. They're like, Amazon's also e-commerce, Google's also like search engine and so forth. So they did a good job of dissecting it and just to kind of show how big is it just specifically the cloud revenues. So for AWS, they're at 36 billion in cloud revenue for 2019, and then 17 and 9, right? And then the interesting part to me was that their price to sales multiple, because my price to sales multiple in the enterprise software in the public markets are like 15 to 20. Their price to sales is very conservative at 8x, right? So something like a BlackBerry trading at 6x, that's undervalued, right? Something like a Carbon Black was, but something like a Cloudera, right? Why are we bullish on that? Well, it was trading at 5, 6 price to sales, and they see that 8, but in reality, this is what they see, and that's a conservative bet, which I like for if you were to present this to me as an investor. But in like real market dynamic timing, I'm seeing things are going at like 15, 22. So this is conservative, right? And if you were to add up that implied 8x valuation, this would be the valuations of these 3. So Microsoft, these 3. So 72 billion, 136, and 288, right? In terms of like their entire enterprise value, so Amazon's worth, let's say, 900 billion. Their cloud business would be about 288 within that 900 billion, right? 31% of their business, 13%, 9%. So do you think Google Cloud building Google Cloud the building next to 237 over here, or is it that way? 237 that way, at 9%, like you think it's gonna be at 9% of their portfolio?
It's gonna grow.
It's gonna grow, right? It's gonna grow, and that area is gonna be, the beauty of an enterprise, if you think about it, right? They hire HR people to bring in the talent, and the talent has to physically live here, and we're here. That's the passion that that I'm seeing. It's incredible, man. They're gonna make this ecosystem a lot more exciting.
So earlier it was taking them a long time to create a Google Cloud Engineer.
Yeah.
And one of the teachers from whom I learned machine learning,
Yeah.
he's the one who's now creating the capability of creating Google Cloud Engineers in a much shorter duration of time. Right? So it's just taking off like crazy.
So you know how else like stuff like in the beginning when Bernard came in, we were saying how like I noticed like you don't just talk about stocks in here, right? Because we kind of go everywhere. But it kind of ties back to the equity, the ownership at the end of the day. So how does knowledge like this help me out in every day, right? Because this question was like, do you know anyone in here that would take the bets that you recommend or talk about, educationally recommend? I said, I don't know, but I think stuff like this could help you in every dimension, right? It helps you in terms of like, what type of network do I want to associate myself with? What type of career path do I want to pursue, where local growth and all that? To, how should I invest my money, obviously? And then one way it helps me is that when I know stuff like this, and I'm talking to like a commercial real estate developer who knows nothing about tech, but has the ability to invest massive amount of funds into commercial real estate, I think I could confidently advise on which areas we should consider stacking on top of tax government opportunity zones, right? Government opportunity zones in Palo Alto. Isn't that insane? Yeah. Like these guys, and they know nothing about tech, right? So we just gotta go raise some money and buy up those opportunity zones in Palo Alto. I mean, it might sound super bullish, but they're printing money. They can't stop printing money, so they can't stop devaluing the back end, and then the mass amount of people will have to keep working harder. So what does that say? Work matters, right? But passion in your work matters a lot too, because if they're gonna print money, devalue they're gonna front end visually give you a confidence, but behind your back, at the back end, they'll engineer your robbery or whatever. That forces you to work harder. So if you forecast and you know you're gonna work harder, pick something that you really like. Because if you don't, then the economics are gonna force you. I see it, and from a macro perspective, it might not be like instant, but it's what you're really concerned about is the people around you, right? I tell you, like, you could stand still, but the economics below your feet are gonna move. And here in Silicon Valley, it's not a train, man. It's like a bullet train. It's Elon Musk's Hyperloop over here. So that's the reality of it. But
So can you make? Oh, go ahead. Can you make a bad bet on real estate today?
see, that's you see what I mean? Like it's I talk to people and they tell me, like, and I'll repeat, like, I don't understand how people are surviving in the valley. Like all of my kids' college tuition were financed through real estate. Like I paid it through all the appreciation. I don't know how everyone else is surviving. So from that perspective, I would say we talked about this before. We socially engineered this store of value, right? Where someone like a doctor could go to school for 8-10 years, come out with inflated college debt, right? And then have to work a lot of hours to pay that all back. Did you want to see it in here? We got right here. Yeah, we got one right here. Yeah. So going back to that, right? We've engineered the situation. Okay, a doctor that saves lives, 10 years of education, comes out with a lot of debt, have to work another probably 10 years to pay it back, and then start life, right? 20s is the new 30s. Again, all the economic stress will push your life out. Perceived wise, I mean, it depends on how you perceive it. I wouldn't perceive it that way. Now on the other side, right? You see a realtor graduating from high school, coming out making $500,000, $700,000 because they know how to get deal flow. Because we engineered the price, our standard of living, to reflect it in real estate. Because they're in a highly protective, inflationary protected position, right? Meaning no matter what, they're going to charge 2.5% on a property, right? So if I were to visualize it, if you go to work and they don't give you equity, you don't have exposure to equity, you're just getting fixed income, then as they print money, this is standard of living, or this is real estate prices. As real estate prices go up, this is you. This is your earnings right here. You're a donkey on a stick, in my opinion, right? Now, if you get into real estate, let's say, and prices inflate, and you broker that reflection of standard of living, as prices go up, right? But has the real estate agent's position evolved? Has it become a PhD level type of activity? No, not at all.
I mean, if you're really good at hooking your customers, then you can do it
yeah.
anytime.
Well, I mean, let's use this. So college prices have inflated, right? But do the professors get better at teaching? You're coming to my free lecture,
They can only be so good.
Exactly. So think about this. So their quality of education is constant, let's say, or maybe let's say they're checked out too. It can be constant to decline sometimes, but the cost of tuition goes up. So what's the bang for your buck then? All right, I'll draw it out right here, from just pure economics perspective, right? If the college professor's skill set is like this, right? If they're not innovative, if they don't want to get better, right? For me, I like to push and get better. So for me,
So
my
you have tenure.
huh? Yeah, sure. So then, if you were forecasted out, it almost looks like an options chart over here, right? But the cost of tuition looks something like this, right? Because we inflated money. So what's happening? Especially when you cross this area right here, you're getting really ripped off.
Well, it depends on how much the degree is worth in the marketplace.
That's exactly right.
Yeah.
Like,
Yeah.
That's why you're there. You're not there to win. You get a piece of paper.
So
Yeah.
if you get a liberal arts degree versus a engineering degree,
Yeah.
who do you think 5 years from now will be going back to the little graph that you
Yeah.
have that's going
Yeah,
like this?
yeah,
You didn't mention, of course, that half of that growth is in the Bay Area,
Yeah.
right? I mean, in the previous lectures, you've shown the
Yeah.
maps of where these
Yeah.
companies are, right? So when you invest in property, you're kind of speculating on the future, right? How much is going to be more demand? They can't invent land. They could make it. You could put land in the bay and fill it up and build a house on it, but that's not happening. So that graph, if you think that, like you're saying, this is just the beginning, 50% growth year over year
Yeah.
means I'm hiring more people
Yeah.
year over year. I'm paying those
Yeah.
people huge amounts of money. Engineers make staggering amounts of money.
Yep.
So I mean that means that guy's got or person's got another $250,000 versus the person with the liberal arts degree that doesn't. So
Yeah.
that person's renting from the person who's the engineer who buys the house, who rents it out, who becomes wealthy over the next 10 years.
Exactly.
That's how it works.
That's just how it works. And if you guys recall the 3 ways to make money, right? It's go to work, business, and investing, right? And the trick really is to understand your exposure to things. So if you're working, then this is your exposure to inflation, because the corporations have incentive to keep down your expenses because you're an expense to an entity, right? But when you own your own business, you're exposed to inflation, and you have tailwind. Because as they print money, prices inflate, you do more business. Again, I always use a cup of coffee. $5 cup of coffee, next year they print money, $6 cup of coffee, you made more money. Now, the difference between that, the chart-wise, is actually the same for investor as well as business owner. Can you tell me the difference though? It's the same in terms of inflationary exposure, but it's different in terms of time.
The amount of input that you get.
Exactly.
That you have to
In
put
terms of time. So the investor position is the most, well, I'm biased. It's the most powerful, I'll say, it's the most powerful position because you could leverage. You could invest in multiple, like I'm from oil and gas, like I always say, but I invest into AI. I've suddenly got AI exposure, inflationary exposure, but I don't know anything about AI. But that's going to make me rich, right? But I got that through cutting through all the forests of learning about AI and just investing into the talent that learn about AI. So it always gets back to the human capital at the end of the day. Because if you go to the sovereign level, you analyze what the sovereigns care about. They don't care about money, they print money. They care about commodity resources and the human intention. Or human capital, human trafficking. Holy shit. That's pretty funny, huh? I mean, that's really what they care about if you think about it. So, yeah. So I see it now. I mean, when you learn about the different layers. So that's why you gotta. I mean, you everyone starts off here. I get it, right? But eventually, I'll tell you the story. Okay, everyone born in this world, in my opinion, has to work, right? The question is, are you working for someone else, or are you working for yourself, or are you investing into someone who's working? But you gotta work, because that's how value creation and trading occurs. You in your lifetime, from beginning to end, you're not always going to be a worker. You're going to retire someday. Maybe sometime in your life you're going to start a business, but you're not always going to be an operator because your body decays. So you got to retire one day for that. But for your entire lifetime, you're always going to be an investor. So that's why you should maximize your investment knowledge. That's why I get motivated. So we're always investors, regardless of our time, our network, our financial assets, which is a tool that we, engineered and gamified among ourselves. But that's why I feel deeply to always be an investor. Hunting unicorns is going to be technology focused to help entrepreneurs who want to operate. but I don't want to operate. I want to show them, what's a great way to operate, but I want to invest in them. Because at the end of the day, I'm an investor, I prefer to be an investor more than an operator. But I understand that, time premium wise, I have the energy to operate still. So in the meantime, I'll operate up front, extract that revenue to later invest. But that's how you get leverage. You need leverage. And there's different, I've learned that there's different forms of leverage. There's like social leverage. Everyone knows financial leverage, right? You buy a home, 20% down, 80% from the bank, that's financial leverage. I've realized that there's also knowledge leverage. The more you learn, the more you can stack knowledge, right? And then I also realized there's social leverage. Social leverage is like basically you know a lot of people, and it kind of intros you into niche groups and so forth. And then I also realized there's technological leverage, which is like we create new infrastructure that gets us even further, but no one's using it, right? So it's where some millennials are seeing opportunities, right? You hear about these millennials becoming influencers. Well, they're tapping into the latest and greatest technology, right? And they're going against the grain of what everyone else says. Hey, go 9 to 5. But they're just kind of playing this technology right here. So I pay attention to technology now, right? Technological leverage, social leverage, or networking leverage, intellectual leverage, and financial leverage. I play with financial leverage options. So leverage like that, you can stack leverage like crazy, right? I will know everyone at, let's say, ServiceNow, and I will place option calls on ServiceNow, as well as I was also a venture investor into ServiceNow, right? And I will deeply know, the intellect, the knowledge product of ServiceNow. Those are several layers of leverage if you think about it, stacked on top of each other to engineer a return, which is, oh man.
When you're looking at these cloud services and the nature of what the cloud does, generally speaking, how do you view it? Is it like the companies are telling us we need the cloud and they're advertising to us and trying to get us to need the cloud, or is it that it's really solving a problem?
No.
And that's what's generating the value.
Yeah. So the value, all of this stuff right here, this is all infrastructure, right? Last week we talked about Twilio, and I said everyone in here is using Twilio, but you don't know it. But it's what you do in a day. You use your phone, you use Twilio, right? You come into this office, you use electricity, but you don't think about it. So these investors are, let's say a little bit more conservative. They're investing, towards the root, not the end of the root, right? They're going upstream, if that makes sense.
Sure. I mean, I'm still, I guess, looking at it in terms of.
So
if you're talking about
demand-wise,
infrastructure,
right?
I think about roads as infrastructure.
Yeah. So it's based off of end user usage.
Okay.
Software is amazing because it teaches you the structures of life. A lot of like software models life. Yeah. So it's really end user demand. So how do I analyze end user demand, right? Let's say something like AWS. What stacks on top of AWS? Salesforce. Are we going to use more Salesforce? I think so. Why are we going to use more Salesforce? Because consumers are going to consume. Producers are going to talk to each other. SMBs are going to produce and talk to each other. But why are they talking to each other? Because people want to watch more Netflix, right? So you got to analyze the snake from the moment it eats the tail all the way around back to the head.
Okay. So on the consumer side, the thing that drives the need for this thing is really a set of addictive stuff, right?
It's okay.
Netflix or some other content that we can't step away from, possibly discretionary if we had control over ourselves.
And now we're digressing, because when you talk about control over ourselves, because I meet so many people and I see it, we get influenced by the marketing. It all starts with the marketing, I feel.
That's
the marketing,
what I feel too. Like
the marketing says,
is driven by marketing.
The marketing says Netflix on a Friday night, and you watch Netflix, and then the producers all in the back end will adjust, right? Everything from Twilio to AWS, Azure, and they're competing for your Friday night to watch Netflix. So that's it. All starts with just noise.
Okay, so do you use marketing generally as an indicator for an area to start digging?
There's so many. I mean, there's so many layers, right? Like if you do global macro, right? When I look at global macro, I'm looking at why did Russia just secure a deal with China? It's such a big deal, right? Oil trading, because that's going to kick back in terms of like currency, volatility. But what if I want to go down to the enterprise level and ask, like, well, why is Apple partnering with Salesforce? Because Salesforce sees that the world's moving towards mobile first, and Apple sees that they need a growth, opportunity.
They need to move.
Right? They need to move. We got too many consumers. We need some producers who need mobile first. So let's deploy Apple instead of Samsung. right? So, and I could go down to like, you know, why are we, you know, let's say down to our level, right? Why are you, what's another? Why are we watching Game of Thrones so much, right? Because someone, I mean, the number of crowd, it goes back to that video of the guy dancing alone. It starts with one guy dancing alone. You remember? I think you remember the video, right? It starts with one guy dancing alone, and he's just like, he's doing some weird moves, and then it attracts like a few people, right? And they start dancing with him, and he starts cheering them on, and next thing you know, it's a huge mob, right? Like in stocks, it's like momentum trading, right? When something like a cloud area gaps up like that, everyone gets like, oh shoot, it's the thunder, right? It just came in, we got to jump on that. So momentum starts picking up, and then they start distributing. It's I mean, no matter how much AIs are coming into a game, I see the human nature behind every chart.
Sure.
But I do understand that there's computers now, and sometimes in certain situations, I know there's just computers playing. Let's say an unpopular stock no one cares about, it's mostly computers. But when it gets really popular, the emotion kicks in. I see the same chart patterns over and over, right? So chart patterns work best when emotions are at the highest, typically volume. Yeah. So like a breakout. Yeah. So we combine it, everything from like global macro to technology to trading to like human nature just now. But that's what I see.
In infrastructure like this, I guess the development of it compared to historically other infrastructures like, you know, farming,
Yeah.
it's an infrastructure
Yeah.
that needed to be rapidly developed to feed people.
Yeah.
This isn't like that. This is more like
There's several.
we're feeding something that marketing has created.
Yeah.
Like we're
So
creating infrastructure for something that's really artificial, which is new.
Yeah.
That's a new way of business really kind of growing itself.
yeah.
And how do you see that perhaps changing?
So-
the power of marketing is so huge.
We're gonna get into it. It talks about how because of this marketing concept, well, because of consumer demands for like new marketing concepts, like let's watch Netflix, let's use Instagram, let's become influencers, whatever, right? It really push the heat on like servers and data centers to outperform like this, and so they have to adjust. But as they adjust, they're gonna need services like MongoDB and all that, more scalable database models, peer storage or whatever for storage hardware, et cetera, et cetera.
Okay.
So again, it's a big snake eating a snake. It's just a matter, is that snake's eating the snake, right? So if you ever,
Sure of that.
yeah, that's why I wish I had my own class. One day I'm gonna have my own classroom, I hope. Snake eating tail, right? So if you look at this, right, my question is, if a snake eats its tail, it gets smaller, right? In our sense, we're eating our tail, but we're getting bigger. That's called synergy.
Okay.
That's why I call this club. You know, it's 1 + 1 = 3, but I say 1 + 1 = 10 because we're in Silicon Valley, right? So I think that's what we're trying to achieve. But why do we market? If you really want to get into the origins of why we market, it's to get you to trade. I get you emotional so you can trade. The moment you trade, you don't count it's not 1-1 trade. It's like 1.5 to 1.4. There's a spread, and there's ways to pull money from people. But a lot of people don't see that because they're not quantitative oriented.
You know, one of the things you said before, a lot of this is tied to the greatest asset in the world, which is time.
It is. Everything
So
is.
just think about, let's say for the holiday season, it wasn't that long ago that if you're going to buy gifts for somebody, you go to 10 different stores,
Yeah.
you look at something, then you go to another store and you say, oh, they got a $3 less, oh, here's another store, all this bullshit time, right? So you wasted the whole day, as opposed to, you open up Amazon, you know that the price is either lowest or good enough, you click on it and it's done.
Yeah.
So
yeah.
what it would have taken you a whole day, you did now in 3
Yeah.
minutes.
It's all. At the end of the day, everything comes down to beating time.
Exactly.
Yeah.
Exactly.
Yeah.
Why do I need an Apple Watch?
Yeah.
You don't really need it.
I'm a big fan of watches.
No, but you don't.
You don't need it.
Really
You don't need
need
it. But
right?
we
You
want
can
to
live
make.
without it.
This is getting into marketing, which would be
Right.
we would be talking about this stuff at Hunting Unicorns. Because it's more, all right, how do we get your guys to need it when they don't need it?
No, but all of this.
So that we can build more cloud storage.
But-
Exactly.
No, but see, all of this
Yeah.
translates to services that people are using because of time.
Yeah.
I could get a taxi, it'll take me 15 minutes, or I could use Uber, which is running on
Yeah.
Twilio, running on Amazon, and get it in 3 minutes.
Yeah.
So all of those things, this is like the food
At-
chain is driven by all of these.
At the end of the day, this is like the hard truth, right? Don't get sad, but when I analyze it, right, from the top down, from sovereign down to consumers,
Right.
Typically the time value is robbed from consumers,
Absolutely.
right? Because we encourage you to watch Netflix. The producers that own the equity, watch Netflix. We produce great content, right?
The reason basically to reduce the infrastructure cost of every
Yeah, yeah.
organization that they
Yeah.
have to do it.
So let's say you're like someone like Amazon, right? And you're in a different game. You're in a producer game, and you're thinking about, well, which producers are operating inefficiently, right? But if you analyze a stack, those producers operating inefficiently, it would go down to consumers.
Yeah.
So our convenience at the final level is like right here today for now. Later it'll be like VR or voice or whatever. But for now it's in my hands. So I'm saving time by leveraging technology.
Yeah, I think the most organization what they're finding difficulty in moving into cloud is that the security and the initial investment.
So we're skipping ahead already. So I gotta go ahead now because you talked about security. You got a question?
I just wanted to confirm this chart.
Yeah.
Because during the holidays I went to Seattle with family, and then I just opened my eyes and I'm like, damn, there's like 5 new buildings of Google Cloud.
Yeah.
Microsoft Azure is growing like crazy there.
Yeah.
Amazon is taking over Seattle area.
Yeah.
And just if you could pull up the real estate map you had like last weekend and just Google check very quick Seattle how it's growing.
You're talking about the price map that I have? I don't have Seattle. It's just California. Yeah. But we gotta kind of move a little bit here. So yeah, you're right. It's now that I think I've taught enough to a point where my discretion has went past my insecurities, but also the mass culture insecurities, and I could see vividly. So when you talk about when you went to Seattle, you see Amazon and the way the real estate around that has adjusted, right?
It's booming.
But what do they teach you in school? You know,
Yeah,
they teach you to. Well, I'll let you figure that one out.
You don't need to look at the map, okay?
Yeah.
There's 25 buildings. The buildings aren't for dinosaurs or for donkeys,
Yeah,
right?
yeah.
There's people in them.
Yeah.
So they don't build them for fun.
Yeah.
So what are they building 25 buildings in an area that didn't exist 5
Yeah.
years ago? Which means they're going to need another 100,000 people in there. People tend to like to live in a place, not on the street. So if you have 25 buildings with 20,000 people in it, there's 20,000 houses that people are going to want in the general area because no one wants a 6-hour commute.
Yeah.
So I mean, it's the food chain. The fact that income is driven from revenue growth, which drives buildings, which drives people, which drives spending, which drives houses, which means every house. When Amazon was going to announce their corporate headquarters in New York, every house went up immediately because people thought, well, someone's not going to live in Connecticut, they're going to live in New York. So every home goes up 25%. It's exactly the same thing.
Yeah. So I didn't accidentally fall into investing.
Right.
But through investing in teaching, I accidentally fell into throwing networking events. And then from there, I accidentally fell into fundraising. And now I might even probably accidentally fall into running a tech community. We don't know yet. But I'll tell you this right now, I don't think I've accidentally fell into this one, but this is like the most beautiful thing ever right here. And I'll tell you why. Because I've realized that everything that, after looking at stocks for a very long time, right? Everything that everyone does out in the world is reflected right here to me. Like this to me is like the ultimate portal. It doesn't communicate in words unless you read like SEC filings. Yeah, but that's not the words that I'm talking about. If you understand prices from a human, like if you are one with the prices, the price action, you start to see, you understand the world more. Yeah, that's why I like this game, because it's constantly teaching me about the world and where the world wants to go, and that's where I started off wondering about the world. But now I've realized we all have the world in our hands now. But the question is, are you going to invest the time to understand the world? Yeah. So yeah, you're right. All the interactions are at the end of the day, you can quantify it. You can see the numbers. It's super fascinating. So we got to move over here. 11:40. Oh man. I got a hard stop at 12:30. That's why. So cloud infrastructure adoption is still nascent, and we are in the early innings. So again, now you dissect the early innings, right? You see that I circled 91% disruption potential. This is what Battery sees, 2019. This is just the best risk reward right there. This is like a 1 in 10 risk reward. Your risk is 1, your gain is 10. But specifically, I like what they did. I don't know if you can see it, but what opportunities are going to grow within cloud, right? Platform as a service, infrastructure as a service, data center services, IT, hardware, support services. So when I think about this, I feel strongly that hunting unicorns is going to be a community that I'm going to build for the next 30 years. Or I'm going to be in that space. I don't know where else I'd go. I mean, I'll go travel and stuff, but come back home and back to the classroom and lecture or something.
So you really only need to catch one, right?
You really only need to catch one.
Okay.
Yeah. And that's
2 years is a good amount of time to do that.
and if it's anything I've learned, right? And I don't know who's online. I don't want to say anything disrespectful. Yeah, I mean, so there's some momentum on my side in the sense that I'm getting intros to like VCs now, right? And I've learned a lot. The game's not fair. That's what I've learned. It's extremely proximity related. You have to be physically in the right location at the right time. And some people could pocket extremely big and fall into becoming a VC, is what I learned this week. Yeah. It's fascinating. But you know, that's the luck of the draw, the hand, right? But you could increase your own personal probability by quantifying your daily, weekly, monthly, quarterly, yearly, and semi-annual efforts and all that. That's what I learned this week. Well, I mean, I already knew that, but it got me more motivated. So I met a VC, emerging VC in SF, and he got an exit from Okta, and now I think he's an investor in Slack. He bought me tacos on a Friday night, talking about technology on a rainy day in SF, if you want to know the vivid details. And you know, he offered me like, hey, if you bump into startups that look really promising, and I know this is like the unicorn land, if I send it over his way, I'll get some of the fee of the funding, percentage on funding, as well as some of his carry. For like, I'm not an LP. I'm not a GP either. But that's an amazing opportunity to be able to participate in this leverage in inflation exposure, right? When you buy Okta, if you're buying shares, then you're like 1x leverage. But if you're buying MongoDB or Twilio or Okta with options, now you're leveraged on a highly inflationary market opportunity. But from a GP perspective, right, a general partner of a venture fund, you fundraise and you're leveraged off that fund, right? And you're invested super early stage, and to get a carry from that, that's a lot of leverage. And I realize anyone can play this game. It's not just me. We all can, right? But it's all about how you get into the game. You could get through maybe knowledge, through a network, or through money, right? Or just being at the right place, proximity-wise, at the right time. That's what I realized. Yeah. Here in Silicon Valley, because valuations are moving quick. But I mean, if it goes bust, then we got gold. We'll see. So that's the enterprise or cloud infrastructure adoption opportunity. Cloud penetration is still early, only at 10% of $700 billion in overall infrastructure spend in 2018. So this is what gets me excited every day. But I mean, there's several markets that I get excited about. I have a comment right here. Oh, never mind. Early crop of open source and cloud native companies are promising. So this is interesting because this is also, it gives me a list of companies that I think are promising to invest in. We can analyze, let's start with this side, recent M&As. So recent companies that got acquired. The one that really popped out to me was this one here. Right, that one got me. But Splunk acquired Signal FX. Now we could go to Crunchbase and identify like, it was Signal FX here in Silicon Valley. Well, who were the executives, because they just got an exit. Now they're probably going to be VCs. Sorry, go ahead. So Google acquired Looker. VMware also acquired Pivotal. Cloudera acquired Hortonworks. Right? Salesforce acquired MuleSoft. I was looking at MuleSoft. Microsoft acquired GitHub on top of acquiring LinkedIn, and I realized they're acquiring networks. They're acquiring intelligent networks because they understand that GitHub is like the bottleneck to like we're all, let's say you're hunting the best developers, right? And all the developers love GitHub. Dude, Microsoft's gonna be a $2 trillion company in my opinion. As we print more money too. They got the support from their partners. Think about this for a second. Like, as an employee, right? The government doesn't really give you, that business tax advantage. But the moment you become a business owner, you're a partner with the government, so they'll get you a little bit less taxes. But who's the best partner of the government? Let's say Apple or Amazon, right? Okay, you are our all-star partner. how much taxes do you want to pay? You know? Yeah. So, and plus you have a huge entity to figure out all the tax strategies and stuff at the corporate level. We're talking about enterprise taxes. We're not talking about consumer taxes or small business taxes, enterprise level taxes. There's no such thing as a sovereign tax, right? Yeah, that won't make sense.
Where did you find this chart?
This is all from Boundary Ventures. So it was, I read a lot of reports every week. I've engineered my own pipeline of reading material, but I never get to digest it all just because I get pretty busy. But this was one of them this week I wanted to share. So yeah, pay attention to what's getting acquired because typically those people become VCs. Select recent IPOs. So how did recent IPOs perform? Datadog IPO at 8, now it's at 10 billion, right? Wait, hold on. This one is, okay, before IPO, and then this is IPO. Think about this for a second. Rubrik, I met Ashim Chanda, right, the partner at Greylock, and he's invested in Rubrik. And he was like, when I met him at his house, he was like, he gave me the feeling that that's my baby right there. Like, that's the one where I made a lot of money. So I'm thinking like that, at that level, his type of investment, his sophisticatedness, I think this guy probably has like 5% of the company, right? And I am pretty sure he got in before 1 billion. It's at 3 billion, only 5%, right? But wait, 5%, what happens when it goes IPO? Something like a Datadog that was, or Dynatrace at 4.9 billion, my bad, you like that one, right? At 4.9 billion, went up to 6.3 billion. So this guy over here, let's say, 3 billion, you IPO at 4.9 and it goes up to 6.3. Because we're flooding the markets with money, and that money will go to the best entities, and the best entities happen to be here in Silicon Valley. And that's gonna make our lives harder. Like, it's like we're Silicon Valley sometimes, it's like, the guy who's like holding the earth on the shoulders. It's almost like that, because the rest of the world is like, we need to find yield, right? We need to find returns. And then all the returns are kind of originated here. So like the people who don't have like real estate or whatever, or a position in these companies, you're like, right? Until it gets too much of a pressure. So I find that extremely interesting and fascinating. But these are all securities that I personally would consider myself as well. In itself is a great list. And that's how we're going to fight the inflationary forces that will rob us if we don't pay attention to investing in the activities. Because it just moves a lot quicker here in Silicon Valley. So that's what I get excited about, really. Sumo Logic, billion unicorn, right? Confluent, Rubrik, Snowflake, Databricks. If Aaron wants to get a job, this is a good list as well. Because you have to start off humble, right? You get a job, but you learn the job, you learn the ecosystem, and you meet the players too, right? And it's not just today's player; you also meet tomorrow's players. So be grateful of that. I'm super grateful of Silicon Valley after teaching and learning all this.
It's not a full list either.
It's not even a full list.
Zoom at 20 billion. Yeah. And okay, another educational piece of knowledge. Think about what these guys got acquired for, right? So GitHub acquired for 7. That means Microsoft's willing to spend $7. I don't know. $7 of $100. 6 billion, 5 billion. You see the average acquisition range, like 15 and 34 is kind of like an outlier. So what do you think about these right here? If it's 6 billion, 5 billion, 2 billion, 6, that's why when I see Cloudera below like 5 billion or whichever, I'm just like, Mobile Iron at 300 million, I'm scared that someone's going to acquire it because I know the level of money out there, right? So I don't care if Mobile Iron goes down because I'm oriented towards the future is mobile first, and they got a world-class VC team and management team, and they got some sales momentum, right? Educational opinion only. But I'm scared that a little $300, $600 million company is going to get acquired for $1 billion. That's like if you get in at 300 million, it's 3x. So yeah, we're all, the companies are also acquiring each other. I'm just trying to figure out how to
Good question.
Yeah.
How would you determine what metrics to use to know whether
the valuations?
Yeah, say Mongo and OCAD. Those look like those went up extremely.
Mongo.
So to determine when they might get closer to their IPO price.
Yeah. So it's your first day.
Yes.
It's current market valuations. So you kind of have to understand, like, let's say a market valuation rubber band. Let's say this is at the market price, and at the market price is 20 times price of sales. Sometimes you'll identify under the market price, like a BlackBerry or Cloudera, at like 5x price of sales. Sometimes you'll identify something like a Zoom that's like at 50x price of sales, and that's overvalued. So that's how we identify, clean valuations. But we want to know if the market's playing these valuations. And they typically do, but you got to play through the noise if you know how. So these numbers, this is the IPO valuation and then the current valuation. That's all. This one is last disclosed valuation. I didn't know Rubrik disclosed, so I was actually, that was pretty interesting, because I think that Sheen probably owns like 5%. That guy lives in Atherton. He probably just like, he told his son to go work there. Yeah. Yeah, it's fascinating stuff. There's a culture here in Silicon Valley, a very interesting one. We're talking fast valuations for equity owners. Note, it's, this is not real estate flipping, but to me, enterprise flipping. Yeah, this is substantial leverage. Developers are innovating rapidly with cloud and open source building blocks. So I just wanted to put this one in there. Number one, software developers are innovating faster, right? The tools are kind of coming out for them. Digital transformation equals rapid innovation. Low code to no code platforms are enabling a large audience to be pseudo software developers. That's, again, going back to when we release mobile devices or AI to the masses, that's higher infrastructure. People are going to get a lot smarter as well as a lot more innovative, whichever. I don't know. I don't know. I mean, if you think about it, like a lot of my marketing stuff is off of, I don't need a code. Well, that wouldn't make sense.
It used to take you like, 3 weeks to develop a website. Now you can do it in
Exactly. Exactly. Like if I could go to market quicker and teach these startups how to go to market quicker, and I have equity in it, then we're gonna create some value. So it's another adventure I want to participate in. This is the investor adventure right here, right? This is the knowledge adventure. But I want to go into the sort of the unicorn battlefield adventure. At least these numbers excite me enough to shift my tomorrow. To excite me about the tomorrow. Pay attention to the low to no code stuff. Cloud is increasing the attack surface and uncovering new cyber opportunities. Cloud security, so it goes from left to right, as you can see. And the timing, I probably have to annotate this so it's easier for you guys. The timing on this, there we go. So we're currently at 2,000. Oh, I'm sorry, we were at 2,000. We're currently here, right? And we'll look at each one. The threat vector. So cloud is increasing attack surface, uncovering new cyber opportunities. So I think these cyber stocks, now this is teaching me from a stock playing perspective that these cyber security stocks probably have a higher premium. So now I'm probably rethinking what should CrowdStrike's valuation be? What should BlackBerry's valuation be? If it's really cyber that they believe is a big market opportunity, 29% CAGR right here, as you can see, 29%. Historically, cybersecurity, 3.2 billion market, 7.4, that doubled. 16 and now 96 billion. Increased attack surface. Threat of the landscape have increased this much. Notable strategic activity. So these would be the current cybersecurity companies today, right? And Okta's in there. And Carbon Black is in there. And Zscaler is in there. That's publicly traded. CrowdStrike's in there. Right? Forescout I've seen, but I don't think that's public. SolarWinds, I haven't heard of that one. But this is all stuff we got to pay attention to because it's only opportunity for us when it becomes public. But I realize now most of the private game is proximity. From proximity, it's here. So I want to play it here as well as the public games. So I'm getting more. If anything, I'm getting more passionate about this market landscape. Not just digitally through investing in stocks, but also getting into the again the unicorn battlefield. Look at the increasing size of the threat landscape. So substantial cybersecurity seems pretty hot. And again, I don't think John Chen's a dumb guy, and I don't think Prem Watsa would risk 15% of his net worth in BlackBerry. If it wasn't a thick 80% gross margin business with government install base, meaning they don't have to put as much effort in building a relationship with the government because they already got the historical relationship, right? It's like calling up your ex. In a way. To some extent, you ended well, right? Like, hey, BlackBerry, we know we ended with the BlackBerry phone hardware, but we're software now. Right? I've changed now. That's the sales reality, right? If I were to teach startups today, I would talk about like, okay, where's your sphere of influence? Where's your strength? Let's start networking in that segment and get you into the right guys to contact for the deals. And grow your startup. Major enterprises are finally modernizing, transforming their IT stack. I think, I mean, they say finally realizing, right? And they're spending more money now, which is good because, again, this is not just like the investors investing into Silicon Valley, but it's also the world brands investing into buying Silicon Valley company product. Going back to the, a little bit more, we got the whole world now, right? So yeah, I'm not trying to sound extremely bullish on real estate, okay? No matter what market conditions, it looks very drooling and attractive. You always have to practice sound investment practices, okay? You can't just go in and I'm just gonna go price it 2x premium. No, we gotta be serious about this. So just be aware of that. 50 years. So my partners, I would say, they were this part of this innovation period, and now I'm thankful to partner with them to kind of build out this next innovation period. I don't know what it'll look like 50 years later, but that's probably true. Yeah, we will verticalize a lot more, right? If I were to pick up these opportunity zones in Palo Alto or whatever, I mean, yeah, we'll build something now, let the valuations go up, then we'll tear it down later and put up a high rise or something, because I see the trajectory. Because again, when I look around the world geographically, where's the majority of cloud infrastructure being built? If this is one of the most bullish markets in the world, where's the infrastructure? So it's here, right? So I think we'll verticalize one day, but not yet. So if you feel like the space is getting tight, I mean, you haven't seen LA then. LA is pretty bad. I don't understand that one. They got some vertical towers too. So anyway, Silicon Valley is a recent phenomenon, and only now are multi-generational enterprises realizing they must catch up, because that's where the growth opportunities are. So these VCs get their exits from these enterprises just by winning some of the enterprise deals. You see where the enterprise guy came from? I try to invest as much as possible at every angle. Every company is a software company, so I thought this was pretty interesting. The blue is technology, and then the number of technical employees is in here as well. So Microsoft has the most number of technical employees. I don't know how they define technical employees. Many non-tech companies are already hiring software developers on par with technology companies. So you see this right here? Microsoft is high. This is why I think Microsoft could be a $2 trillion company easily, right? They have the most, technical employees. And by technical employees, they define it as software developers. If they acquired GitHub, where software developers hang out, they could easily pick talents because it's in their bucket that they own. Oh, we want that fish today. We want that lobster. That's a good one. That's a crab. So I see. And I mean, they're even more crazy by acquiring LinkedIn too.
Microsoft's been around for a long time.
Yeah.
Actually, if you think about it, way back when Bell Labs was the only place in the world where you had all the PhDs.
Yeah.
Okay.
Yeah.
The minute Microsoft started getting bigger, they kept on acquiring all this stuff.
Yeah.
And so they have a lot of stuff.
Yeah. So like I said, the shell, like the startup might be the same, but the soul is different. Well, it's definitely a different Microsoft soul all over the years. Like people change. Companies change just as much as people. But what I realized about companies is that we compact people into these entities, and it becomes like a mass organic type of culture or human being, mass human being. Interesting stuff. So yeah, and let me know if you have any questions on that. So this is everyone else, and then this is probably this would be a cool proprietary investment metric that I would consider if I had my own analyst. Okay. I would tell, hey analysts, get me all the companies with the most software developers, right? Who has the most? I'll invest based off that. You should probably outperform, and I'll call that portfolio the software developer portfolio, right? Companies with the most software developer portfolio, and see how that mini portfolio performs. And if it performs really well, then I'll pour money into it and scale it up through that proportion of technical employees. Because I believe now more than ever it's the chase for human capital, because I've learned it from the sovereigns. So if Microsoft's chasing the software developers, well, these three has the most right here. I'm not surprised.
Yeah, but I think that's a slippery slope, because companies have
It
more
is.
software developer. It doesn't mean that the company valuation and the stock will be performing better, because except the top tech stocks,
Yeah.
if you look at GE, it's down in the dumps.
Yeah.
If you're investing in GE, probably you're renting now.
Yeah.
Honeywell, Wells Fargo, none of them have done it. But
Yeah.
it does say that these are technical employees, but I think may not be entirely correct to correlate this with the investment fee.
Yeah, it'd be too much of a slippery slope. So what you would do is, like we always do, we don't just look at price of sales. We look at market cap, we look at management, we look at product, we look at market opportunity. It gets pretty layers of analysis, right? I'm just saying this will be one awesome proprietary indicator to stack on top of who's buying, what product, what market opportunity. Man, you could get some like cool, I mean, this is just data playing. You're playing with data here. And you could generate some powerful investment just where directions are going. Yeah, I get increasingly, again, excited for all this. The opportunity for software to reach non-desk workers is only beginning. So you know how I said like the whole economic decay concept, right? The whole like, you know, Bernard telling me we start off with the office space with a door, downgraded to a cubicle, downgraded to open space, and then probably downgrade to work from home. But then now it's like, they're talking about, you know, global, like getting everyone to be as productive as Silicon Valley. What do you think that would happen to just how dynamic the world would become? If everyone's skill set, if everyone was a lecturer like me, man, I don't even, yeah, if everyone's lecturing, I don't really have an audience anymore. I have to actually really compete for an audience. Yeah, it's so this is telling me like if we were to, I mean the future, forecasting the future, right? The secular trend, a worldwide, you know, desk workers to non-desk workers, 600 million desk workers to, you know, opportunity in terms of non-desk workers. Crazy stuff, right?
Okay.
Yeah.
So what guidance would you have for people in the room on how do you determine what % of your portfolio to put into cloud anything, as opposed to other very successful companies like the Walmarts and the Targets and the McDonald's and the whatever?
I first would ask you, what's your goal? Are you conservative, aggressive, or just you want to be neutral? That's the first question I ask.
Okay.
Yeah, and if you say aggressive, then buy the cloud index. If you say conservative, aggressive, right? Like conservatively aggressive, probably like gold miners. Yeah, really. With options, right? That's conservative aggressive. But if you want to just go neutral, probably won't be cash. Because cash is, I mean, depending on how much, it's decaying, right? And inflation. So I'd probably go bonds, right? Corporate bonds and commercial real estate for conservative, right? Residential real estate, I mean, depending on the valuation, what you get in, you have to understand the local pockets, right? If there's like a strong corporation around, then I would price in some premiums. But if there's not, then I don't know. So that, I mean, that's how I would advise, depending on your personal, your age will, and depending on your age, you know, we could even do data analysis on that. If you're like in the older age group, you would say more like conservative, right? And if you're in the older age group and you say, I want super aggressive, then I'd be like, this guy's onto something. Something's different over here. This is a unicorn. This is an outlier. But why, right? So yeah, that's what it depends on. And I mean, like, look, we've seen enough portfolios where like we could look at your portfolio and say, do you want to just, you're happy with the amount you have and you could already exit the world, then you want to do 1%, 1%, 1%, 100 position, or you're not happy with your portfolio and you want aggressive exposure, then okay, let's do 15%, 15%, you know, 5%, 5%, 5%. So it's all relative to net worth, time frame, demographic group, amount of money, and goals and emotions and all that. Several layers. So that's the working population, right? If you look at enterprise value, 31 billion enterprise value from non-desk workers. Yeah. So meaning my interpretation of this is basically, this is the value you could get from the people working, and then these are people that are not even working yet. And so 600 million, we got 31 billion. But I don't think I interpret that right. So I'll follow up with you guys, send you guys this deck, and let me know what you think, because I'm curious to know on that one.
This is saying that the opportunity worldwide is much bigger. We only tap into a very small portion of it.
So in that sense, it should be taking this out.
Right.
That's what I was thinking too. Okay. Next one, because I'm running out of time here. 50 billion connected devices and data are transforming every industry. So things connected to the internet in 2005 was 500 million stuff or devices. Today we got 50 billion. So if we got more devices, then is that a good thing? And yeah, it's a good thing in a way, but it also means you got exposure to some risks as well, right? you know, your IoT connected light is, you know, giving people access to your bank account. Right? You have a lot more risk points at this point. People on Earth, 6.3 billion to 7.6. And I love this metric that they did. Connected devices per person.
Right.
It's 6.58 per person now. That means every person here, we got 6 devices that are connecting us to the internet.
Only 6?
If we were to use the entire world.
Oh, the whole world.
Right?
Oh,
Now that's if you assume you average around the world. But if you just focus on Silicon Valley, it'd probably be higher than 6.
Right.
It'd be like 20.
Right.
I don't know.
Your car alone will have so many computers talking outside, you don't know.
And now I understand you know why investment bankers of Wall Street are leaving Wall Street to come to Silicon Valley, because in the last financial crisis, and I've learned through being at Morgan Stanley, after the financial crisis, they came in with a ton of regulation, meaning like this was a game that was making a lot of money on Wall Street, but they regulated it, so it's like it doesn't pay to be an investment banker as much as it used to. So what do? They go to the Wild West, because what I realized about there's different natures of markets out there, right? Efficient markets like financial markets, there's AIs, but in inefficient markets there's a lot more opportunities, but the spread's a lot wider, which is good if you're a dealer in that market. So I'm seeing that trend of you know, Wall Street back in like the 80s and 90s, 70s or whatever, to now moving forward. I strongly think the momentum's here. At least I see the top performing private equity groups being tech based, like Thoma Bravo to Vista Equity Partners. They're kind of actively here as well. But you never know. These unicorns now could pop out, you know, in the world everywhere, because we're increasing the infrastructure around the world. I'm hearing VCs have to fly around a lot more to source these unicorn deals. So, again, interesting stuff. Selected industries impacted. Medical, I think, electric vehicle, cities, security, to industrials. So the theme of each period was data and privacy over here in 2005. 2010 to 2015 was security, and then today is operations management. There will be 50 billion devices connected to the internet by 2020, generating more data than ever before. More data than ever before. Cloud era. Not Cloudera, Cloud era. Not a recommendation, but MongoDB.
You know, the key, of course, is this, you know what these things that are connected to the internet all have in common?
What?
People paid money for them. So what that means is that 25 billion devices were bought, which means they're connected to the internet. What does that mean? They're connected to a whole bunch of crap in the cloud that makes those devices work.
Yeah.
So if you look at that from 2025, that means there's going to be like 100 billion devices. Yeah. So that means that every device sold comes down to generating income, generating profit. If you're investing in that type of the industry and not a coal mine that's going down to zero, you're betting on the right horse.
Yeah, just bet on the market.
Exactly.
Yeah, someone like you, buy a cloud index.
Absolutely, absolutely.
Now, I was just thinking, like, you know, 6.5x per person, right, in terms of devices exposed, security risks. But think about it from a parent perspective. Your kids, right? Your kids today are like, they're exposed to a lot of different points, more than ever. So I think being a parent will become even harder. If becoming a parent is even harder in this economic landscape, then maybe I should invest into like a, you know, parent to child IoT device management software company.
Child will know how to run that off.
But that's consumer facing, right? That's consumer facing. I'm not thinking about the parents' bank account risk. I'm thinking about the risk of the kids now, right? Because think about what that level. So this is the pitch. I'm already pitching. Like, what's the level of, like, you know, information points going to do to your kids? You're a software engineer. You know this stuff. You're in IoT. That could be a great pitch. I don't know. But that's how I would generate opportunities if I were to look at it. Cutting edge companies are pushing the envelope with AI machine learning. All right, I'm gonna have to end real soon here because I got a hard stop. I do apologize. We'll have to. We barely scratched the surface. Well, no, we did quite a bit. Let's see. So, okay, I'll give it 5 more minutes. Sorry, guys. It's like usually I teach until you guys get tired and leave me, but today I gotta leave you. So I'm sorry. Cutting edge companies are pushing the envelope with AI machine learning. So I thought this was really interesting. How these guys are using their own forms of analysis, right? They're leveraging Google Trends popularity. And so these are the words that they have in there. This is really great because this teaches me how to identify future market opportunities as well before it gets popular. If you look at the word enterprising, for some reason I did, it's actually downtrending. So maybe if I could work that thing back up. I don't know. Computer vision, right? 2009, 2019. To machine learning, the trend's up, and then NLP. I haven't learned much about NLP. Has anyone in here like dived deep into that?
I'm trying, okay, I try to work on a chatbot, didn't go very far.
Yeah. Yeah. So the beauty of these like inefficient markets, right? They're new markets. No one's monopolized all the information. So if you don't have money to invest from a capital perspective, you can invest from a time perspective by building a network in NLP, ML, AI, and you'll meet investors who need your intelligence. So you don't have to have money today to play this game. Just you could build a network with the knowledge, right? In a highly aggressive growing market. So you become a specialist at computer vision, machine learning, all that. When SK comes to me and say, "Kay, I want to get into real estate," I'm like, "Dude, you're an engineer. You could get into these markets. Save your talent. Go here, right? I'll cover you on the real estate side." Because he will get introed into these VCs, these esoteric groups, right? So yeah, it's exciting here. Applications with the enterprise. So the whole corporate stack could be disrupted if you think about it. IT, engineering, HR, compliance, accounting, customer support, sales. There's so much money in the enterprise space and opportunity that I think these unicorns and to-be unicorns have to be identified. And then that way I could, if I raise funds or distribute equity, that'd be cool too. So anyways, I have a hard stop. So without getting into the numbers, guys, it's been 2 hours as well. We'll call it here. We'll continue maybe next week if possible. But hope you guys enjoy this. You can still stick around. I just gotta leave the office by 12:30. That's why I wanted to end it sooner so you guys could chit chat.
That's great.
So hey, thanks for coming out. Let's see.